At end July, we didn't need a rate cut. Mid-September, we needed a 50 basis rate cut. And now we're talking about caution on rate cuts.
But if this market keeps changing narrative.
People might say they're bearish, but when you look at the positioning and look at their equity exposure, it's still relatively high.
A month ago, we said that investors were nervous bulls. Now they have just become bulls.
It's become a good news is good news, bad news is bad news type of environment.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. That feels good, doesn't it?
It does feel so good.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with your equity market on the S&P 500. Looking a little something like this and poised for a sixth week of gains on the S&P 500, the longest weekly winning streak of the year so far. We're up a tenth on the S&P, on the Nasdaq a bit of outperformance, up a third of 1%. Apple, the stock to watch. In a pre-market, the stock is up by 1.2%. Apple in China. Counterpoint Research. Sales of the iPhone 16 up 20% in the first 3 weeks compared to 2023.
Big question here about whether this is a matter of China sales outperforming based on a very low bar in 2023 due to supply disruptions, et cetera. Or is this a sign that we've seen a bottoming out in consumption in China and that, frankly, the spurs that the government is providing to people to really go buy things is not just going to affect Chinese companies?
Well, they're off to a good start, but the issue is you have these national champions in China that are also still doing well. It's a very competitive market. Dan Ives, though, just on what Danny Bergern said, Apple's getting its mojo back in China. He said China at one point was a tail risk. It was a headwind, and now it's a tail risk.
Better news out of Taiwan Semi, better news potentially out of Apple, and decent news out of Netflix. After the close yesterday, the stock is up by 5.6% in the pre-market. Lisa, I think this is a clear true beat across the board.
It was a beat across the board with actual subscriptions coming in much higher than expected. Okay, I hate pouring cold water over it. I'm asking questions. Is it just from a low bar with Apple? But with Netflix, is it just a matter of them cracking down on password sharing? And they can keep doing that and keep adding to their subscription rolls because people are addicted to their different shows and are going to pay for it to get their subscription. Yes, Anne-Marie. But I do think that, there is a question of how far can this actually go?
You can't out me for my password
already
stealing on television. But the issue is now, are they going to be at peak, basically, in the growth? Because as much as you crack down on password subscription, at some point that stops. How much more can you grow? And that's what analysts are a little bit concerned about.
Didn't stop overnight. Stock still rallying in the pre-market, up by close to 6%. More on that story a little bit later. I want to pick up on the story with crude. Brent and WTI just a little bit softer. No drama here, not a big move. Down by about a third of 1%. Brent at 74. WTI at 70. New developments in the Middle East in the last 24 hours. Israel killing the leader of Hamas. The U.S. pushing now for a ceasefire.
That's right. Yahya Sinwar, the Israelis announced, is now dead, the leader of Hamas. So President Joe Biden got on the phone with Benjamin Netanyahu. He briefed reporters as he touched down in Germany, saying there is an opportunity now. There is a chance potentially to move on, to get a ceasefire agreement. But we need to wait and actually see, because Benjamin Netanyahu spoke yesterday and it didn't seem like they were ready to give up.
There are a lot of questions, like who are they even negotiating with at this point? How do we even understand who the leadership and where the balance of power actually is with the Hamas group, where the leverage is going to be, and what this means for Iran? Israel has not yet retaliated against Iran. Either way, a lot of people are saying this gives the hope that maybe we could finish this conflict on both sides and once and for all, but there's still quite a bit of distance between now and then.
Going into another weekend, still waiting for the same thing, waiting for that retaliation. Brent crude 74.27, WTI 70.52. Coming up this hour, here's the lineup for you. Geoff Yu of BNY with traders dining back rate cut bets. We'll catch up with Norman Rule of CSIS as Israel kills the leader of Hamas, and Jason Bazinet of Citi as Netflix posts another strong quarter. We begin this hour with stocks poised for a sixth straight week of gains as traders dial back rate cut expectations following better than expected economic data. Geoff Yu of BNY is cautious, writing data are now refusing to cooperate. September's job and inflation figures in the US have upended any expectations of more aggressive easing. With the US election also looming, the window for risk appetite to improve further is looking very small. Geoff joins us now for more. So, Geoff, let's get into this. This bond market, do you think these higher yields, back through 4% on a 10-year, are starting to become a little bit of a headwind for equities?
I think so, but the markets are trading on a day-to-day basis right now, a week-to-week basis, at least. I wouldn't rule out, next week we get some data prints, be it on the consumption side or otherwise, or earnings, anywhere in the world, to just pour some cold water again. I guess this is less of an equities or even bond market story right now, but within FX markets, for example, I look at some of the key pairs, I think, with the election looming right now, so that aspect of risk appetite, which has been surprisingly subdued, or risk aversion rather, been surprisingly subdued of late, I think that's coming through into markets now.
Jeff, let's talk about the bond market then and compare a spread. The German 10-year versus the US 10-year. That spread has been widening. We're threatening to talk about 200 basis points all over again. And I just wonder how much wider you think that spread can get, because we had Mohamed El-Erian on the programme just yesterday who suggested this ECB is going to cut more than this Federal Reserve in the next year.
I absolutely would not rule out 50 basis points for December, and the fact that Madame Lagarde did not rule it out yesterday, I think, is quite telling. Had some reports just now saying there were some governing council members wanting to remove the notion of restrictive, but guess what? In the statement, straight off the bat on Bloomberg, the second headline was actually restrictive to remain. So I think quite a bit of conflict there. Let the data do the talking for Europe, but the bias is absolutely to the downside. US can stay. US yields can still where they are, even taking into account the risks up ahead, but the direction of travel for German yields in particular is down given the lack of supply.
So we're talking about the bond yield spread. I'm wondering about the currency spread and whether this means that there's a greater likelihood of parity once again between the euro and the dollar. This is something that a lot of people are talking about. Where do you fit in this discussion?
Well, I started with parity at the beginning of the year with less than 2 months left, or just over 2 months left. I think that's a bit of a stretch. I still think we can see 105, but it's less about what's left for the rest of this year, another 50 basis points. How much for next year? For the Fed right now, 25 basis point clip cuts every single quarter. For the ECB, I think it's going to be much more aggressive than that. So for the next 6 months, mid next year, parity absolutely still going to be my target.
So there's a question, Jeff, about what's driving this, right? Is it essentially interest rate differentials that's driving the currency market right now? Is it growth differentials, or is it the politics of the moment? And I'm wondering what is going to drive your look at this in terms of the potential for increased tariffs to actually affect the euro and make it weaker? Or is it a matter of, further rate cuts, are they good or bad for the euro if they potentially could support growth?
So I go back to our positioning numbers right now. I think one thing I should have really respected a bit more was how underpositioned people were in euro over the last 12 months, or rather how overpositioned people were in US assets, full stop. Not just the dollar, US equities, US bonds as well. Our cross-border clients are still buying US debt right now. So that needs to start to come off or stabilize and to allow the euro a clearer path. But to your point about tariffs, absolutely. Remember, tariffs, you're essentially imposing real effective exchange rate appreciation on the nation you're imposing tariffs on. So euro will absolutely be affected if that's going to be on the way. And if anything, I look at dollar MEX, that's pricing in a risk. I look at dollar renminbi, dollar yen, they're pricing in risks. It's not being priced in euro dollar. And also, alas, one of my favorite currencies, the Swiss franc, because I look at Swiss Pharma, that was a target 8 years ago and could come back online again over the next few months or so.
So, Jeff, what you're seeing play out in the FX market, is it basically pricing in a Trump win already?
I would say yes. If you're looking at where dollar MEX is and dollar yen is and what the market is trying to do with dollar CNY, though there are other aspects out there. I look at implied volatility, so the insurance, being put on. Mexico is a factor right now, dollar Swiss as well. So that's why I said earlier, in the FX market, election risk, that is really starting to come to the fore relative to other markets at this point.
You're not alone in this euro parity call. A number of people have come out and said this is not far-fetched anymore, given how potentially the polls are looking towards the U.S. election. But would you maintain that call if Kamala Harris wins?
I would maintain the call because at the beginning of the year, it was really very minor in terms of what the election held. My euro call was based on European growth disappointing to the downside. That has materialized. And as the PMI reports have been highlighting, it's structural. There is not going to be a cyclical upturn next year. I just don't see where it's coming from, given the manufacturing constraints across the auto industry, the tech industry, for example. It's that which is going to drive things low in the Eurozone, especially as public spending comes off and services inflation comes off. They're going to undershoot to the downside in inflation. It's a Eurozone story.
Jeff, you've just screamed a load of lists, a load of things that I think scream get long bonds. Are they just another reason after another reason to get long duration in Europe?
So within Europe, pick your market carefully at this point. And I do think that markets do want to get back into France right now, notwithstanding the gyrations regarding politics earlier this year. I'll look at our flow data. Two things matter. One is issuance and supply, and secondly, it really is yields. And that's where probably some of the large issuers, France and Italy, still have an advantage. As much as I'm worried about the Eurozone right now, fiscal is one thing I'm not concerned about due to NGEU, due to joint issuance. That's not an issue until 2027 when we get back to the next budgetary negotiations.
Jeff, it's good to hear from you, sir. As always, Geoffrey Yu there of BNY on the European backdrop right now. It's not good. He's just gone through a list of things. And a lot of those things just add up to the same thing, which is get long. European bonds are not. European equities are not the European single currency either. Christine Lagarde's guidance hasn't changed. The data has. She says meeting by meeting, we're data dependent. I think the market's doing the work for the ECB now for them. They're looking for even more interest rate cuts from the ECB. And I think we've all heard the same thing over the last year or so. Recalibration, normalisation, recalibration, normalisation. How long before we start to hear the word easing in Europe? That they're easing, looking to get policy accommodative because the outlook for growth is so bad.
How much is the reason why they haven't done that just simply because of dissent on the ECB committee, as Jeff was talking about, because clearly there are some people who are in the mindset to go there right now. What strikes me, as you were talking to Jeff and saying, doesn't this make you go long European duration? When will European governments say, OK, if yields are going that much lower, let's borrow to actually juice growth? And that, I think, is sort of the natural question mark when it comes to the fiscal side of things.
And the worst for Europe may still be ahead of them. Christine Lagarde yesterday talked about the idea of barriers, which Donald Trump recently said there would be tariffs on places like the European Union. She said that would be, quote, downside risk. Potentially, this can get so much harder for Europe.
Jeff Yu, looking for parity on euro-dollar into next year. 108.42 is where we trade right now. I mentioned this call from Deutsche Bank yesterday, Mark Wall. Today's decision represents a pivot point into a faster normalisation of monetary policy. A lot of people echoed that yesterday following Christine Lagarde's news conference. With an update on stories elsewhere this morning, let's cross over to Danny Berger with your Bloomberg Brief. Hey, Danny.
Hey, John. UK retail sales rose for a third straight month, thanks in part to demand for consumer tech, including the new iPhone. Sales rose to the highest level in more than 2 years, now just 0.2% below pre-pandemic levels. The data is a welcome boost for the new government. It had been accused of hurting sentiment after signaling tax increases in this month's budget. Netflix shares higher in the pre-market trade, 5.7% higher. The streaming giant added more than 5 million customers last quarter. It eclipsed Wall Street's estimates on every major metric. Netflix co-CEO Ted Sarandos says that sales for the period grew by 15% to more than $9.8 billion. Fox News' interview with Kamala Harris was the most watched of the campaign season so far. Fox said that Harris's interview attracted 7.8 million viewers. The half-hour segment, which aired 6 p.m. Eastern on Wednesday, drew a bigger audience than other Harris TV appearances. That includes the CBS News 60 Minutes one and ABC's The View. It also beat the 3.1 million viewers who tuned in to Donald Trump's town hall earlier on Wednesday. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, ramping up the rhetoric on the campaign trail.
My opponent feels like she does not have to be here. I guess you should have told her the funds were going to bail out the looters and rioters in Minneapolis.
Don't say anything negative about Catholics. I would never do that, no matter where I was. That would be like criticizing Detroit in Detroit.
That conversation up next, live from New York City. Good morning. Live from New York, welcome to the program. Equity futures on the S&P up by 0.1% here. On the Nasdaq 100 up by a third. Better news out of Apple. That stock is up at a pre-market by about 1%. Poised for a 6th weekly winning streak. 6 weeks of gains on the S&P 500. The longest such streak going all the way back to December of last year. In the bond market, 2-year, 10-year, 30-year shaping up as follows. A 10-year yield that's just a little bit higher and holding on to a 4 handle, 4.09%. We've talked a lot about Europe. The German 10-year is trading with a 2 handle. And the spread between the 10-year in Germany and the 10-year in the US is threatening to break through 200 basis points all over again. Europe and the United States right now seemingly headed for two very, very different worlds. That's the bond market. Switch at the board and get to the commodity market. Gold, 4-day winning streak. On the year, up by more than 30%, taking out 2,700, a new all-time high.
To me, what strikes me is that gold is outperforming right now the S&P 500. It's outperforming stocks. It's outperforming bonds. It's outperforming other commodities. Right now, why is gold the biggest outperforming asset right now out there? It's telling us something. What's gold telling us? I mean, honestly, this is what people say. At the same time, there is this feeling, wait a second, if you have the deficit concerns, there's so much uncertainty. What is the new haven trade, especially at a time where inflation could be potentially a big unknown risk in the future?
There's a lot more short-term concerns for investors than the deficit. That is one stateside about this U.S. election, but also what's going on in the Middle East, especially when unclear with potentially what this could mean in terms of a wider regional war. Gold is a safe place to hang out.
Do you remember when Mark Zandi came on the show of Moody's? He said, Lisa, gold, really?
I'm still on it.
How many weeks ago was that?
This is
Were you
for
thinking
you.
of Mark as you were saying that?
It's your victory lap.
You know, honestly, it's not my victory lap, although I think that gold is something that's important to look at, and I don't think I'm alone. I get a lot of messages about gold. I see advertisements on late night television. No, I mean, in all seriousness, there is this question about whether you also see this into crypto. I get comments always, too, like, hey,
Sure.
boomer, you're not paying attention to crypto, but you saw a lot of assets into crypto also in the past week.
They call you a boomer.
I know.
That's pretty brutal, that is.
I know I'm not a boomer, but there is a question here about where the havens are at a time where potentially the deficit and some structural inflationary forces could present that as an upside surprise.
Top in 2,700 in the commodity market for gold this morning. Under surveillance this morning, ramping up the rhetoric on the campaign trail.
My opponent feels like she does not have to be here. But if you really wanted Vice President Harris to accept your invitation, I guess you should have told her the funds were going to bail out the looters and rioters in Minneapolis.
Thou shalt not bear false witness to thy neighbor. Indeed, especially thy neighbor's election results. And maybe don't say anything negative about Catholics. I would never do that, no matter where I was. That would be like criticizing Detroit in Detroit.
Here's the latest this morning. Donald Trump and Kamala Harris trading insults at last night's Al Smith dinner in New York. Harris opting not to attend in person, instead sending a pre-recorded video message. Both candidates heading to Michigan today with the election entering its final stretch. Joining us from the nation's capital, Bloomberg's Joe Matthew. Joe, I think we're still asking the same question. Why didn't the vice president attend that dinner?
You know, it's a great question, and it's one of these things that we'll talk about in hindsight if this doesn't play out for her. Should she have gone? Should she not? The campaign decided that being on the campaign trail was time better spent. It's kind of a bizarre evening, though, Jonathan. We're talking about a Catholic fundraiser supposed to be, you know, kind of good-spirited. Everybody gets together. Never thought we'd be talking about Mary Catherine Gallagher on surveillance, never mind before that particular crowd last night. And by the time Donald Trump got on the stage, the insults started flying. He questioned Kamala Harris's intelligence. He questioned the manhood of her running mate and insulted her husband, all before he had actually nice things to say about Chuck Schumer and Eric Adams. He was on the teleprompter. He was off of it. He was actually complaining about that. He brought some written notes to read some of the jokes to the crowd here. But you've been to these dinners. They're supposed to be lighthearted. We heard as many boos as we heard laughs last night.
We also heard a lot of people applause. One of those, I think, Joe, was when he did mention one campaign promise, which is basically a U-turn from something he did in office. Is the former president serious about SALT?
That's a great question. And I think that for that room, yeah. When he's talking to New Yorkers, yes. But look, Anne-Marie, we have the same conversation here all the time. There are elements of Donald Trump's proposals when you consider tariffs and some of the other ideas he has about the border that he could do through, you know, executive action. He's going to need Congress. He's going to need the Ways and Means Committee and even Democrats from places other than New York to make the SALT thing happen. Whether or not this is a major priority of his, it's part of a series of tax proposals that he's made, and he likes to get around to them in front of audiences like that. Kamala Harris is spending a little bit more time, you know, fooling around with him, getting into the personality aspects, and that's more of what the evening was.
So we're, you know, just a few weeks away now, Joe. We did see Kamala Harris sit down for that one-on-one with Fox News' Bret Baier, bringing in more than 7 million viewers, the biggest we've seen in this election cycle. Will she do more of these types of interviews?
Well, there's a CNN town hall scheduled for next week, but you know how this stuff goes, Anne-Marie. Maybe she'll show up talking to you guys one morning. I think the campaigns are taking this day to day, and they do what they think they need to do to appeal to, in some cases, very narrow demographics. If we think we need to talk to Wall Street, we sit down with John Micklethwait. this week. If we need to talk to young black men, we sit down with Charlemagne the God. These have been really game day calls that we're seeing. And to your point, without a debate or another major event here in the next 2.5 weeks, I think you're going to see some interesting ad-libbing from the campaigns in the swing states.
What are both campaigns doing today?
Well, it's on to Michigan today, as Jonathan mentioned, and they're going to be there over the course of the weekend. I'm going to be very interested to hear how Donald Trump is received in Detroit. Kamala Harris was apt to remind everybody last evening that he was insulting Detroit. The governor and others throughout the state have made a big deal about this. It reminds us of when we got to Milwaukee, the RNC, having called it a horrible city. This is something that's going to follow Donald Trump on the campaign trail, knowing that he has to win the state of Michigan. They both do. There's a very critical Senate race there as well. We just saw a debate this week between those two, and you're going to be talking a lot more about down ballot just as much as you are the top of the ticket in Michigan.
Joe, forgive me, but even as we start talking about how they get the last votes, I'm still trying to figure out what their policies actually are. And I have to say, in that Fox interview, Kamala Harris was talking about how Iran is the biggest threat facing the U.S. A lot of people were surprised to hear that it wasn't China. And then you had Janet Yellen yesterday speaking, Treasury Secretary, saying trade and investment with China can bring significant gains to American workers and firms and must be maintained, talking about the necessity for a healthy economic relationship between the two. Do you have a sense of what the delta is between the approach to China between Donald Trump and Kamala Harris?
Well, to be honest with you, I think the real question here is what's the difference between Kamala Harris and Joe Biden? It was a very interesting moment in that interview with Bret Baier on Fox News when she said that this will not be a rubber stamp, not a continuation of the Biden administration. And people are really trying to find cracks there to see where the sunlight is. Difference between Kamala Harris and Donald Trump seems to be fairly stark just when it comes to tariffs alone. But we have to remind ourselves that the Biden administration kept all the Trump tariffs in place. They're still there today.
Joe, we've got to leave it there. It's got to catch up. Bloomberg's Joe Matthew with the latest down in Washington, D.C. We'll see you a little bit later. You can catch Joe a little bit later as well at 8:45 Eastern Time. We'll speak to him again for the week ahead down in Washington, D.C. and beyond with the campaign trail.
Yeah, I think that a lot of people are wondering just how much there are people who are undecided who actually will turn out and what that will mean. In the meantime, I do have to wonder what the actual policies are, how much what one person says at one place is going to actually go into effect. And that's the reason why you asked Geoff Yu, are we seeing essentially Wall Street bet on the Trump trade? We don't even understand what that Trump trade will look like the day after, should it be realized.
But I think a lot of people are looking that would be a weaker euro, because what Donald Trump has already said he is willing to do when it comes to China, when it comes to the European Union. The walls are going up, and you can bet their team is already looking at the legality on how they can actually approach this.
Andrew Balls at Pimco was reflecting on this. We were talking about the bad growth out of Europe, the need for the ECB perhaps to cut interest rates even more. This was just another risk on top of all of that when it comes to positioning in European bonds.
Yeah, and the fact that essentially you get to a point, and you asked this question, at what point are we talking about interest rate differentials, and at what point are we talking about growth differentials? And at what point will the rate cuts actually help support the euro simply because you could end up with more growth? Of course, you add potential tariffs on top of that, and all of a sudden it gets really muddy, which is the reason why I think a lot of people are kind of sitting on their hands or just going into gold.
The one big unknown for me is not gold. The one big unknown for me, or maybe why this is gold is actually higher, is what happens if there's a contested election. Ray Dalio talked about this overnight, and he said, when asked about the chance of results being contested, he said, quote, if it's a close Trump loss, I would say it's almost an even probability, referring to Donald Trump, saying that potentially is going to be on the table if Trump loses, and it's very close when it comes to these margins. And what history has told us is this is going to come down to maybe, 80,000 votes in a few states.
Libby Cantrill of Pimco on this story a little bit later this morning. Catch that at about 7:15 Eastern Time. Up next on this programme, we'll catch up with Norman Raw, the former senior US intelligence official, as Israel vows to press on in Gaza following the death of Hamas's leader. From New York City this morning, good morning to you all. Equity futures just about positive on the S&P 500, up by a little more than 0.1%. In the bond market, yields just about unchanged and holding on to 4% on a 10-year, very close to 4.1%. From New York, this is Bloomberg. New leadership over at CVS. CVS has lost almost a fifth of its market cap through the year so far. The stock looks like this in a pre-market. Bramo, new leadership. Karen Lynch is out.
Yeah, and David Joyner is now its new CEO. This is the Wall Street Journal is reporting that they are going to miss guidance, and it's after we already heard from Walgreens that they're going to be cutting stores. It just raises a question about whether this is a delivery kind of performance issue or whether this is something more structural in terms of some of the headwinds facing this industry.
CVS down about 10.5% in the pre-market. More on that story a little bit later. Let's turn to the broader market. Equity futures on the S&P 500 firmer by a little more than 1/10%. The Nasdaq up by 1/3 of 1%. Thank you, Apple. We'll talk more about that story in just a moment. Apple up in the pre-market by something like 1% through most of this morning. The stock market heading towards a 6th week of gains. If we achieve that, the longest weekly winning streak of the year so far in 2024. Switch at the board and get to the bond market story. The 2-year, 10-year and 30-year playing out as follows. The 10-year just about unchanged at 4.09%. Before this week, 10-year yields have been climbing for 4 consecutive weeks. Can we make it a 5th on a 10-year? We're poised to do just that at the moment. On a 2-year, 396.74, just south of 4%, briefly popping through that in yesterday's session following much better numbers, retail sales, jobless claims in America. If we switch to the board and get to foreign exchange and compare the two stories, better data out of America, the Citi Surprise Index the highest since April. It keeps beating expectations. Then compare it to Europe. Dreadful. Euro dollar 108.45. That currency pair firmer by 1/10 of 1%. Just moments ago on this program, we caught up with Geoffrey Yu of BNY, who suggested that there was a real threat, a risk of dropping to parity next year.
Especially if you have an ECB that just acknowledges that it has to be easing rather than just simply adjusting policy, recalibrating like the United States. A real question here about how far this difference can really get, this delta. And I ask that question when you start talking about, do you go into European bonds? Can you see that happen without dragging down U.S. yields as well? Is this sort of truly a separate story?
How much of a decoupling can we actually see? 108.45 on a euro is where we trade right now. Under surveillance this morning, China's central bank moving to support markets after data showed the economy expanding at the slowest pace in 6 quarters. The People's Bank of China disclosing more details of its measures to boost capital markets, including share buybacks and equity swap tools. Not enough to lift sentiment over the last week, that's for sure, but just a little bit of a shining light, a bright spot. Apple. Counterpoint Research reporting that Apple's new iPhone is up by 20% in sales for the first 3 weeks compared to the same period just last year. That's the kind of thing we want to see in China.
Especially with consumption in the latest read, retail sales actually beating expectations, and it came after there was that cash supplement to certain homes to actually boost consumption. A real question here, there are 2 issues. One of them is boosting consumption. The second is boosting the stock market. 2 very different things. The PBOC is on board. So whether it will actually go into effect and whether it will actually have a benefit for international companies, we don't know. The Apple news definitely a bright spot in terms of that. But on a larger scale, it seems like all the different prongs of the government are in tandem saying we have a problem and we need to put a floor under it.
Apple is up in the pre-market by 1.3%. Another name doing okay in early trading is Netflix, adding more than 5 million customers in the 3rd quarter, beating Wall Street estimates across the board. The company predicting sales next year will increase 11 to 13% to as much as $44 billion through a mix of new members and price increases. Lisa, that stock up by more than 6%.
And we talked about how a lot of this is crackdown on password sharing. So there is this natural growth in subscriber bases. But if you go beyond that, there's a real question here about whether we're seeing a consolidation of leadership in terms of which streaming sites are actually going to be the ones that win out. And Netflix, where shares have quadrupled since some of the lows recently, really has showed a staying power, particularly catering to people in the younger cohort who obsessively binge watch at night.
And also getting into live programming. Next month, there's going to be a boxing match on Netflix. Then I believe around Christmas time, they're going to have 2 NFL games, live games. So basically, they're starting to realize that you can't just have the classic Netflix series or movies. They're going to start to get into some live programming. And then if you want to watch a football match or basketball match or boxing match, you have to subscribe.
Live programming. An appointment to view. There's very few left in broadcast. sport is the one, which is why sporting rights have cost so much over the last few years.
And we've seen that increasingly creep to other platforms. I just wonder at what point do you end up losing some of the audience? I'm just thinking about the cohort in my household who binge watches and whether they're binge watching sports. Some of them, the Mets, yes, but some of them, you know, if they're locked out for too long, they're just not going to go there.
Well, you know why it's annoying? It's hard to find where the sports are actually streaming now.
Yeah.
And we've talked about that on this programme quite a few times. Let's give you an update on the Middle East. Israel killing the leader of Hamas and the mastermind of the October 7 attacks that ignited the war in Gaza. Israel vowing to keep fighting until all the hostages are released as the US pushes for a ceasefire deal. President Biden writing in a statement, "This is a good day for Israel, for the United States and for the world. There is now the opportunity for a day after in Gaza, without Hamas in power, and for a political settlement that provides a better future for Israelis and Palestinians alike." Joining us now, leading our coverage out of the region, is Bloomberg's Jumana Basechi in Dubai. Jumana, do you think the United States could get what it wants to see?
Well, that's certainly the question, and certainly the U.S. see a window of opportunity here after the killing of Yahya Sinwar. It's difficult to overstate how central of a figure he was for Hamas. He's been part of the party for over 20 years now, a political prisoner, for many of the decades that he was in Hamas. But then he was also put on the terrorist blacklist, the U.S. terrorist blacklist back in 2015, and of course was the mastermind of those October 7 attacks. So he has for very long been on the target list, and there have been several attempts to eliminate him since October the 7th. The successful attempt obviously happened in the last 24 hours. Now, what happens from here, you've got to take into consideration multiple different angles. Of course, the U.S. are saying that this is a window of opportunity to push forward with those ceasefire discussions. You even heard the Vice President Kamala Harris say something to that effect as well, saying that this is an opportunity to finally end the war in Gaza, and it must end in such a way that Israel is secure. But a few considerations. Number one, who is going to be replacing Yahya Sinwar at this point? Are they going to choose somebody from within the Gaza Strip, in which case it may just be a continuity of the actions that we have witnessed the last couple of months? Or will the appointee come from someone residing outside? Khalil Hayya, for example, is living in Doha currently. He has less political influence within the party, but has been privy to some of those mediation discussions that have been taking place. The second element to consider is the Israeli stance, which is, again, comes back to the comments that the Israeli Prime Minister put forward yesterday, saying the mission is yet to be completed, and the number one focus for the Israeli government right now is to secure the release of those hostages still being held in captivity. There are about 100 estimated to still be alive. And the second element is to completely disarm Hamas and pave the way for a new type of governance in the Gaza Strip. As of yet, Hamas have not indicated that they're willing to go down that route. And then in addition to that, you have all of the considerations, the regional considerations as well, with the Iran mission to the United Nations posting on X today that the spirit of the resistance will continue despite the death of Yahya Sinwar. So there's no sign yet from the region that there is going to be hope for a ceasefire deal crossing the line.
Jumana, appreciate the update. Thank you. Jumana Basechi there of Bloomberg out of Dubai. Let's continue the conversation. Joining us now is Norman Rule, former senior US intelligence official. Norman, welcome back to the programme, sir. I'm sure you heard those comments from Jumana. Let me ask you this. Do you think this could be an opportunity? Does it open the door to a ceasefire?
Good morning. It's too early to tell. As your correspondent correctly noted, we need to see who replaces Yahya Sinwar in Gaza. If it's his brother Mohammed, who is a bloodthirsty individual with a terrifically violent reputation, that tells you that Hamas will continue along its current track, and the Netanyahu administration will do the same. If, however, you have a leadership that is more willing to engage in compromise, then I think you're going to see an opportunity for pressure on the Netanyahu administration to do the same. The coming week should give us the answers we need to say where this problem is going.
Norm, President Biden yesterday said Antony Blinken will be going to the region, his 11th trip since the October 7th terrorist attack from Hamas on Israel. What does he need to do to potentially warm Bibi Netanyahu to this idea of potentially that opening for a ceasefire?
I'm not sure there's much the administration can do with Prime Minister Netanyahu. The Netanyahu administration, to include the security establishment, are committed to the eradication of Hamas as a military threat. Now, they've achieved eradicating Hamas and Hezbollah as strategic threats, but the violence in these areas continue, and the organizations can reform. I think it may be that Secretary of State Blinken's greatest success could lie in Doha, where if he's able to convince the Qataris and others to push Hamas to bring forth a more moderate leader, then you have the opportunity to then put that leverage against Prime Minister Netanyahu. It's also interesting that the visit by Secretary Blinken is taking place at a time when an Israeli attack on Iran is expected. Does this visit mean that the Biden administration believes the attack might be postponed, and therefore they're not sending the Secretary of State into an active war zone? Does it believe the attack will take place prior to the visit and come with no Iranian retaliation? I think the Iranian attack aspect is an interesting part of the Blinken trip as well.
Or maybe they're sending Secretary Blinken to buy time so there wouldn't be a retaliation. You mentioned eradication of Hamas and Hezbollah. Yahya Sinwar yesterday eradicated. Hassan Nasrallah September 27th. Mohammed Diaf, the head of Hamas's military unit, was also in the summer, October 1st. And then Ismail Haniyeh was in Tehran in July. Who else is Israel targeting?
Well, I think Yahya Sinwar's brother, Mohammed, who has been targeted by Israel on multiple occasions in the past, is certainly on their list. And Israel's intelligence collection in Gaza and Lebanon will be focused on identifying those individuals who are demonstrating themselves to be commanders or organizers or focal points for militants in those two countries. And those attacks will continue for the foreseeable future.
How much weaker of a position is Iran right now, Norman? And I ask this as we await what kind of retaliation Israel will have. At the same time that we just got reports about the U.S. using bunker bombers on certain sites of military aspects for the Houthis. How much weaker is Iran right now?
Well, Iran has lost its external strategic punch. For years, if not decades, Iran has been able to communicate that any conflict with Iran would include powerful proxies who would launch a vast number of ballistic missiles and drones on Israel and the United States. And although these actors can be rebuilt, their arsenals replenished, they are not strategic threats in the region. They are long-term, persistent sources of conflict. But Israel's survival is not threatened by the Houthis, Hamas, or Hezbollah at this point. For Iran, therefore, this puts it in a weaker position. Although, again, Iran plays a long game and is looking at a future where it can restore the potency of these militant organizations.
Is this the reason why, Norman, some people think that this is actually a time where we could get some sort of ceasefire, could get some sort of deal, simply because Iran wants to play the long game and make sure that some of its proxies remain?
That's correct. If you are in Tehran, diplomacy is an avenue by which you can sustain these groups. A ceasefire, even for a few weeks, would allow these organizations to reorganize, to reestablish communications between commanders who have been literally under fire themselves and therefore unable to establish command and control over units in different parts of the country. Even a short-term ceasefire would improve Iran's power position in the region, and a long-term ceasefire would allow the Quds force to just rebuild, replenish, restore these groups to their previous capacity.
Norman, just a final word from you. I just wonder how you're thinking about things and how they're coming together. Do you think Israel is following the same troubled path of the United States in Iraq? Is that the direction of travel here?
Yes, and in part what we're watching is what happens when a country perceives a strategic threat, but no political or military leadership is able to foresee too far into the future. And we don't know what's going to happen in Gaza. Is it conceivable the Gaza war is in its early stages? Could we see a post-Hamas organization spring up resembling Daesh or resembling or a new militant group? This is entirely possible. Absent a ceasefire, a two-state process, and some political solution in Lebanon, these possibilities remain, and the long-term nature of these conflicts is a strong possibility.
Norman, a clinic from you once again, sir. We appreciate it. Norman Rule there, the former senior US intelligence official, with an update on stories elsewhere this morning with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. Gold is on a record-breaking run. The precious metal topped $2,700 an ounce for the first time. Concerns over a wider war in the Middle East and U.S. election uncertainty has investors flocking to haven trades. Gold is about 2% higher on the week. Bank of America also noting this morning in their latest research note that gold posted its biggest inflows in 12 weeks. Good news for Apple overseas. Sales of the newest iPhone in China are up 20% in their first 3 weeks compared with the 2023 model. Analysts had warned that iPhone 16 might fare poorly in China given the absence of a local partner to power AI features. Beijing has barred foreign development AI models, meaning Apple may have to secure a local partner like Baidu. CVS is ousting CEO Karen Lynch and appointing David Joyner as its next chief executive. Joyner previously led CVS Caremark, its pharmacy benefit business. CVS had repeatedly missed its earnings targets, and that set off unrest among shareholders, spilling into public view in recent weeks. CVS also said that this year's third quarter results will fall short of Wall Street expectations. And that's your brief, John.
Danny, thank you. Let's turn now to the India Credit Forum in Mumbai, where Bloomberg News Deputy Editor-in-Chief, Reda Gregori, without the promotion there, is sitting down with the Reserve Bank of India Governor, Shaktikant Das. Let's take a listen.
You know, the number of institutions which are participating in the bond market, it's mainly the banks, the insurance companies, the mutual funds, and the pension funds, or the provident funds, as we call them. So we need more of institutional investors to come in. This is again one area where the foreign investors can come in. There is a certain cap provided, considering the prudential. There are prudential caps, that is ceilings prescribed for that, but it has not been utilized. Only 15% of the total space which is available for foreign investors to invest into the Indian bond market, only 15% of that has been utilized. So there is considerable scope to access the foreign funding, that is foreign investors into the corporate bond market.
So how do you get
and
the
finally,
other 85%?
just one more point. Finally, I think we also need to focus on, and we are focusing on, developing a robust secondary market for corporate bonds. I think that is something which we are working on, and that's something which will, I think, add a lot of momentum to the corporate bond market. Yeah.
Private credits is the buzzword at the moment. Everyone is trying to get into private credit.
That was the Reserve Bank of India Governor Shaktikant Das speaking with Bloomberg News Deputy Editor-in-Chief Reda Gregori in Mumbai. Up next on the programme, a streaming success.
We had a plan to re-accelerate growth, and we delivered on that plan. You can see that in our 2024 financials. We expect to deliver 15% revenue growth and 6 percentage points of operating margin improvement and engagement.
That conversation up next. Live from New York City, welcome to the programme. Equity futures on the S&P 500 up by 0.2%. Under surveillance this morning, a streaming success.
Looking into 2025, we're feeling really good about the business. We had a plan to re-accelerate growth, and we've delivered on that plan. You can see that in our 2024 financials. We expect to deliver 15% revenue growth and 6 percentage points of operating margin improvement and engagement, which we view as our best proxy for member happiness, because when people watch more, they stick around longer, so that's retention.
So here's the latest. Netflix surpassing Wall Street estimates on every single financial metric. The streaming company expected to keep up momentum with highly anticipated new releases throughout the fourth quarter. Citi's Jason Bazinet has a note of caution. We expect Netflix's stock to trade higher on a US price hike announcement, but we would expect shares to eventually trade lower as investors hope for $25 in 2025 EPS are dashed. Jason joins us now for more. Jason, welcome to the programme, sir. I just wonder, from your perspective, what is the biggest tailwind to subscriber growth into year-end?
Well, I think it's their ad tier. I mean, one of the interesting things, about a year ago, we expected about 80 million ad tier net ads, which was about 25% of their sub base. what Netflix said on the call is about 50% of the gross ads that are coming onto the platform are selecting the ad tier. So consumers are responding to these very low price points, and that's what's fueling the net ads, both in the fourth quarter and next year.
Can I ask you how much pricing power you think they actually have then, with that in mind?
Pricing power on the service. Well, this is interesting. A lot of the bulls were really looking at the rivals that were taking up their streaming product and expected Netflix to take prices up. Netflix has always said that they only take pricing up when they earn it with engagement. And engagement is up really modestly, sort of 1% on average. And so they're taking some price hikes in selective markets. There's about 6 of them they've done. But a lot of the bulls were expecting a price hike in the U.S., so we didn't get an announcement of that. And I think it's a function of the fact that their just engagement is not really growing appreciably.
What do you think will actually drive that growth? Is it going to be market share? Is it sports?
Drive the growth in pricing power? Or
no,
drive the growth
in subscribers, in subs.
Low price. That's the thing. I mean, I think the reality is they're pretty penetrated in the United States, right? And so I think that in a lot of these markets outside the United States where they have the ad tier, that's what's really doing it. It's a really good value if you're willing to take ads.
There's been this idea about a rebundling of media and this idea that there are going to be a couple of winners and everybody's going to go to those, and then there's going to be some sort of package that people can get. Do you have a clear sense of who the winners are going to be in the streaming wars, especially as we get to the other side of the pandemic and some of those disruptions?
I'm not even sure it's a race. I mean, Netflix is so far out in front of everyone else that I think the market has been for a while, thinking of Netflix as to video what, let's say Google is to search, right? It's winner take most.
Jason, when you look at this password crackdown, Netflix seems to be doing a very good job, but most analysts believe it is temporary. How much more do you think that has room to run?
Not much. Not much. That started in the third quarter of last year, so we've lapped it now, and I think it's going to be a de minimis tailwind for them in the fourth quarter and into 25. Very small.
Geographically, where are they growing?
Well, I would say they're growing modestly everywhere. They did have a slight decline in Latin America this last quarter. That was because they took a price hike, which sort of just speaks to this sort of trade-off of if you take price up, you're going to lose subs. So this is why the ad tier is so important, is it allows them to get that low price and not have the sort of consumer backlash.
Jason, appreciate the input from you, sir. Jason Bazinet there of Citi, with Netflix up in a pre-market by something like 6% at the moment, following much better than expected earnings after the bell just yesterday.
Yeah, people thought that maybe they had reached their peak. Evidently, they haven't just yet. Although Jason kind of throwing some cold water on how much more they have to grow given the saturation and given how much crackdown they've already done on password sharing.
So far, so good, though, just in terms of some of these companies, right? Netflix okay, TSMC okay, Apple seemingly, based on that report overnight, okay as well.
To me, the clear message from earnings so far, whether it's the banks or whether it's some of these names that you mentioned, is that the consumer is still strong. Companies are delivering. They're expanding margins. This does not scream of some sort of weakness that leads to any kind of recession, which is the reason why you see that Goldilocks really baked into a lot of market valuations right now.
Stock's still close to all-time highs on the S&P. Up next on the programme, in the second hour of Bloomberg Surveillance, Anastasia Amoroso of ICapital will catch up with Libby Cantrill of Pimco. We'll speak to Kit Juckes of SocGen and Oliver Chen of TD Cowen. All of that in the second hour of Bloomberg Surveillance. Just around the corner, equity futures on the S&P 500 at the moment firmer by a little more than 1/10%. The 10-year yield holding on to 4%, 4.09. Yields higher on the session by around about a basis point. From New York, this is Bloomberg.
We just have such a dynamic economy here in the United States.
It's never very clear when you're coming into a transition, into a normalization, or whether you're getting into trouble.
We're in a data-driven world.
I don't think the data dependency story is real.
I'm not saying don't take data into account. I'm saying don't make it the main determinant, in fact, the only determinant of policy. That's where you make mistakes.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures on the S&P 500 higher by 0.2%. On the Nasdaq 100 higher also by around about 0.4%. Supported by Apple, up by around about 1% in the pre-market. Better news from Counterpoint Research suggesting sales of the iPhone 16 doing better than expected, up 20% in sales for the third week compared to where we were in 2023. That's better news from Apple, supporting the Nasdaq story at 0.4. As for the S&P 500, heading towards a sixth weekly gain, the longest weekly streak going all the way back to December of last year. We've had a little bit of difficulty around the table over the last few weeks. I have to say, the difference between what the data's telling you and what some consumer-facing companies are telling you. Retail sales yesterday, better than expected. Procter & Gamble just a moment ago, it's a relatively softer quarter on the top line. That's the CFO just moments ago.
So this is the reason why it's so hard to extrapolate into something like what you just mentioned with Apple's China's numbers. Essentially, the weak spot here was skincare in China for Procter & Gamble. You start to wonder how much this is a story of idiosyncratic success and failures rather than, say, a wholesale story of U.S. companies still being successful in China or consumer companies still having wholesale pricing power in the United States. This just shows it is a stock-specific market in a very unclear world.
And corporate America facing some very specific challenges as well. It's not just China, it's also the Middle East, sparking boycotts. They're two headwinds to this company.
Right, and the CFO is talking about that in an interview, saying war in the Middle East has sparked boycotts, eroded consumption, and then with China, of course, lower consumer confidence, which we've seen in a number of other companies as well. And then he goes on to say those two are really the headwinds here, but they're trying to say the core of the business is strong. But a lot of these corporate CEOs, the C-suite, are dealing with a lot of things that are really out of their control, and they're having to make do with it.
Some people making the point the core of this economy is still strong. Ellen Zentner of Morgan Stanley, Lisa, this morning's data, yesterday, retail sales, jobless claims, that data highlights the undeniable strength across the economy. So we're asking the question, what does it mean for Fed policy? Chair Powell is unlikely to be swayed from forging ahead with steady quarter-point moves. This note from Ian Lingan of BMO, I think, is really important here. There is a meaningful difference for the Fed between cutting and easing. The Fed is talking about recalibration, cutting back to what most people expect to be neutral. Easing is a very different conversation, and that's certainly not where we're at in this country.
This is a Federal Reserve that's being driven by how much inflation is coming down, not by necessarily perceived weakness. They will just see inflation continuing to come down and say, we just need to reduce our restrictiveness because we don't see a very hot labor market or inflationary pressures. What this is the opposite of a toxic brew, a Goldilocks glory, which essentially we're looking at right now, which is essentially the Fed that continues to cut. You have economic strength, particularly led by the consumer, and you have stimulus from around the world, in particular in China. And those three things come together to give you what you see right now.
I thought it was Goldilocks Nirvana. It's Goldilocks glory now.
You know, I'm going to just keep changing it because I can't really retrieve words. It's Friday.
Whatever sticks. Coming up this hour, Anastasia Amoroso of ICapital as traders pare back rate cut expectations. Libby Cantrill of Pimco on how long it might take to call the election, and Kit Juckes of SocGen with the risk of euro-dollar parity back on the table. We begin this hour with stocks steady and bond yields nearing the highest levels since July as investors pare back rate cut expectations following stronger than expected economic data. Anastasia Amoroso of ICapital writing some risks and unease, like the rebound in yields in US dollar, are still percolating in the background, but given the positive economic momentum, we stay invested. Anastasia joins us now for more. Anastasia, good morning.
Good morning.
What do you think is in the driving seat? Rate cut expectations or earnings? Which one is it?
I think it's a little bit of both. First of all, I think what's really, truly in the driving seat is the fact that the economy is resilient, and that has been on full display this week, actually for the last couple of weeks. You know, if you look at the Atlanta Fed GDP now, it's actually tracking 3.4%. If you look at the Citi Economic Surprise Index, which has been negative for the bulk of Q2 and maybe even, start of Q3, that's actually turned positive in the last couple of weeks. And then we've got retail sales that you pointed out, 0.7% core print. That's really strong too. So I think that's what's truly in the driving seat. But I also do think there's this extension to the rate cut story, which is the rate relief is being felt by the economy. It is being felt by companies across corporates and consumers, and that's starting to support the economy as well. And then, John, to your last point, financials earnings. I think that's been a really, really key development in the last week, and that's why we've seen financials break out to the upside.
The coast is clear for the financials. Let's talk about tech. ASML says there's a problem. TSMC says there's no problem. Is the coast clear for tech going into earnings?
Well, first of all, tech earnings have actually been revised higher, unlike the rest of the sectors that actually have been revised lower. I do think that the setup is constructive for technology. Look, if you look at ASML company, that's a particular technology that goes into semiconductor manufacturing, and you could see why there may be some delays in CapEx for those. But if you look at TSMC, that is the pulse of what is happening with semiconductor production right here, right now. And a couple of things that I heard from that report, first of all, is that AI demand is rock solid and is accelerating. But John, the really, really key thing for semiconductors was happening with non-AI demand. And that's where TSMC was also more constructive, saying that they do expect a pickup in things like smartphone chips and other things. So I think that sets it up nicely for semiconductors.
So there are these secular changes, which is the AI trend. And then there are the cyclical changes, which we see. You said something that I want to pick up on, that you're already seeing the rate cuts filter into increased economic activity. How is it that so many people say that corporate America did not feel the rate hikes, but that so quickly the rate cuts are getting filtered into the economy?
Well, part of corporate America did feel the rate increases. And that part is, for example, if you had a leveraged loan, if you issued a leveraged loan, you were paying much more to service that loan. If you took on a private credit loan as well, you were paying much more to service that debt as well. And that's where we see some of the resets. And of course, commercial real estate, a big portion of commercial real estate loans have been floating rate. And there's a small fraction of the consumers that felt it. But that's where I see the first resets. So for example, in some of the big 5 banks results that we saw, we see debt underwriting really spike, and that means companies are issuing more debt. They're refinancing prior debt, and those debt costs are starting to reset lower for part of corporate America. And then on the consumer side, Lisa, if you look at mortgage rates, for example, they have pulled back, obviously, quite a bit from the peaks, and we are starting to see an uptick in refinancings, and the banks are talking about that. So those are the early indicators that I see.
For a while, in the high rate period, which lasted, it seems like a heartbeat relative to the zero rate period that we had for a very long time, people felt like the bond market had precedence over stocks, that essentially you could earn more and have less risk by going into bonds. Is that equation increasingly shifting as we're seeing currently in performance, but also just in terms of if you can borrow more easily? Doesn't that lift equity valuations and increase the potential growth and sustainability?
It does. It does. There's so many pieces to pick up on there. First of all, now the yields have reset a little bit higher to 4% or a little bit above that. I do think going back into the bond trade might be more compelling. But where exactly into the bond trade do you go? Because if you look at high yield spreads, if you look at investment grade spreads, they're really, really tight. So I don't know how compelling that is, especially if you are individual and you have to adjust for taxes. But on the flip side, I do agree with you, and I'll kind of extend this to private markets a little bit. The reason why I think some of the private equity managers are going to have strong results this quarter and the next couple of quarters is because their debt that they may have taken out to finance some of their buyout companies, that is starting to move lower. The cost is starting to move lower, so therefore the profitability is starting to improve. So I think that's really important.
Just how easy are financial conditions, given everything you've just said? Never mind private markets, high yield spreads, investment grade spreads, they are ridiculously tight, ridiculously tight.
Yeah, financial conditions are easy, but to kind of go back to the point that you made about restrictive policy versus easier monetary policy, I mean, we are still in restrictive monetary policy time frame. I mean, if you look at 5% nominal Fed funds rate and inflation that's, let's say, somewhere around 2.5%, that's 250 basis points of restriction, give or take, versus that. So as easy as the financial market conditions are, I think the Fed can still get easier.
So let's say they go another 100 and financial conditions are this easy. Is there a real risk of a reacceleration in this economy? And do you think we can achieve that without having a spike, another wave of inflation?
Look, I do. I do think the U.S. economy can accelerate, and that's what it's doing, by the way, in the third quarter. And as you think about it, the more quarters go on, the more benefits will accrue from lower rates across corporates, real estate, and consumer. So I do think that for 2025, we're setting ourselves up for the reacceleration. The reason why I don't think this is going to cause this massive wave of inflation that some people worry about is we don't have the imbalances as we did coming out of the pandemic. We don't have supply chain challenges. We don't have as as massive of a shortage of labor. We don't have vacancies. There were, two vacancies per unemployed person. So we don't have those major imbalances. Can inflation stay stickier? Can it stay above 2%? Yeah, I think so. But we're not talking about a surge to 4.
So you're not a gold bug?
I'm not. Look, obviously, gold has done quite well. Which makes sense as real interest rates fall. But at the same time, look at equities. Look at financials. And this has been one of our favorite sectors, to play this pickup in cyclical activity. Look at technology. Look at, by the way, at some of the AI names. I know I've talked to you about picking up the AI semiconductor companies, but actually one of the interesting trades for next year may be the rest of the Mag 7, which I recently not liked because they're the ones that are spending on AI CapEx. But if you look at the AI CapEx numbers for some of the hyperscalers, they grew about 40 or 50% this year. They're likely to grow about 11% next year. So I think the CapEx spending may be tapering off, but the monetization can actually be picking up. So that's where I look for opportunities.
Given what we know about the former president, do you think he's a threat to the semiconductor AI trade?
Yes. I think that is a risk to monitor for sure.
Why is that not being priced in while everyone is, really going in on the Trump trade right now? Republican baskets outperforming.
Yeah, I mean, look, you focus on the secular momentum, which I don't think any president is ultimately going to derail. But I do think that if we do move closer to the possibility of a red sweep, you do have to think long and hard about what that means for semiconductors. Look, companies like NVIDIA, for example, have obviously already pared back some of their sales to foreign stakeholders. But I do think that the headline risk for think about the huge exposure that we have in the semiconductor space from the fact that most of the production is done in Taiwan. Think about some of the other linkages to foreign countries. So I do think it's a headline risk that should be monitored. So I would be aware of that. I would be quick to react to that. But in the meantime, I think you have to focus on the trade that's there, which is AI.
Things could change a lot in a few weeks' time. Anastasia, it's good to see you. Thank you. Anastasia Amoroso of ICapital. Equity futures right now on the S&P up by a little more than 0.1% with an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Some of Nomura's biggest clients have halted trading with the Japanese bank as the fallout grows from a market manipulation scandal. Sources say that at least 10 firms, including major life insurers, trust banks, and asset managers, have temporarily suspended some business with Nomura. The bank admitted to manipulating government bond futures by placing large orders without intending to buy or sell them. LVMH's head of wines and spirits is set to leave the luxury company. According to people familiar, the announcement of his exit is expected imminently. LVMH reported a slump in third quarter sales, with wine and spirits once again the worst performing division. The departure is just the latest in an ongoing shakeup of the executive committee at Bernard Arnault's luxury conglomerate. Harvard is struggling to bring in the type of cash it's used to. The university reported that cash gifts fell 15%, now totaling less than $1.2 billion for its last fiscal year. It's the biggest decline in the last 9 years. There had been warnings around rising costs and alumni anger over the school's handling of anti-Semitism. Some of the university's largest donors, like billionaire Ken Griffin, have paused donations over the past year. And that's your brief, John.
Danny, thank you. Appreciate the update. Up next on the program, the risk of a major delay.
We didn't say election night, so we do subscribe to the fact that it will be more of an election week. The market continues to climb this wall of worry. We think the election's one component of that.
That could be one long week. That conversation with Pimco up next. Equity futures on the S&P up by 0.2% in the bond market, holding on to that 4 handle on a 10-year, up a single basis point to 4.1%. Under surveillance this morning, the risk of a major delay.
We didn't say election night, so we do subscribe to the fact that it will be more of an election week. So once we get past that week, we do think that it'll be a risk-clearing event. We will accept a winner. The market continues to climb this wall of worry. We think the election's one component of that. 2 years ago, it was trying to disprove the recession. A year ago, it was what was the path of the Fed. We think the election's the last rung on that wall of worry.
So here's the latest this morning. The polling averages are tight, with election day fast approaching. The risk of an extended delay is still lingering. Libby Cantrill of Pimco warning, we should expect to see both recounts and litigation this cycle. And depending on how the election is trending, we could see just as much activity from the Harris camp as we could see from the Trump campaign, which could add delays and uncertainty post-election. Libby joins us now for more. Libby, good morning.
It's a run-on sentence.
Are we talking about?
Good morning.
Are we talking about election day, election days, election weeks?
Election days.
Okay.
Absolutely, and that is what we're guiding our clients to. Is that we will not. No one's going to be going to bed on the evening of November 5th, understanding who the president is going to be, most likely, unless it's a landslide, unless we have massive polling error. Yet again, obviously possible. But if polling is somewhat accurate, then this is going to likely not, we may not know the day after, we may not know until several days after. If this comes down to Pennsylvania, and I've said, Pennsylvania is the most important state here. Pennsylvania has just been historically very slow to count, particularly these mail-in ballots. That's sort of the dynamic here, is that with the advent of an increase in mail-in voting, many of these states just don't have the infrastructure to process those ballots quickly. So there's nothing nefarious going on. This is what I keep telling people. There's nothing necessarily sartorial going on. But what it is that these states just take a long time to count. Pennsylvania, for instance, took 4 days to count in 2020. So if this election resides on Pennsylvania, and it may not, but it could, then we may not know who the president of the United States is, again, not until maybe Friday or Saturday of election week.
It takes a long time to count. How much litigation could slow things down?
So, and I've had to kind of refresh myself as well a little on kind of, recent history here. I mean, back in 2020, there were 200 cases, both federal and state. So we should expect even more litigation. Both camps, and this is why I do emphasize Harris too, because I think Democrats, they may have a different style around it. Their rhetoric might be a little bit different, but in terms of sort of the tactics, they might be quite similar in terms of filing cases and what have you. So I think we could see an extended sort of protracted litigation here. But again, if it only resides on one state, that will matter. If it's not that close, then it will likely be noise in the background, a little bit like it was in 2000.
If it's not Pennsylvania, what other state do you think it could come down to?
Well, it keeps shifting, honestly. The sort of blue wall, if you will, that is Harris's clearest path to 270. That's, of course, what we're talking about, just getting to that 270 electoral college votes. So in that vein, Michigan is very important, and Michigan looks more vulnerable for her than it did, 3 weeks ago. Georgia and North Carolina also really important. I mean, she could kind of make up by winning North Carolina. She could lose, say, Michigan or Wisconsin. But again, that's why you kind of come back to Pennsylvania. It truly is the keystone state in this election.
If it comes back down to Georgia, what is going on with the voting there? Because this Trump-backed administration said every single vote had to be counted by hand, which is basically 5 million votes. And then a judge said that's unconstitutional. So where does it stand?
Yeah, so it looks like that may be appealed, although at this point that ruling stands. So there won't be, at this point, the hand counting of ballots. We could see that change, however. And this is, again, just more uncertainty around how these poll workers who actually have to administer the election in terms of how kind of their, what the systems are. I mean, Georgia is obviously, I think they've done probably some of, the most in terms of reforms in response to what happened in 2020. So they're very well prepared for this. But still, I think it just sort of casts, uncertainty in terms of these processes.
It seems like there's been a lot of uncertainty for a long time. We were ordered by you to go on vacation for the whole summer and then to come back and reassess. And here we are in the same kind of muddle. So I do wonder, I'm looking at this and I'm wondering why suddenly we are seeing some certainty in markets. It seems like there is certainty that Trump is going to win. And that is actually trickling into a number of different asset classes. Is there a reality backing that?
Yeah, so I do think, prediction markets, which is where you see a lot of that certainty being expressed, and then as well, crypto and traditional energy, some of these sectors that are likely to do better under a Trump administration. I think that the prediction markets may be kind of getting ahead of themselves a little bit. I think that a lot of what their input is polling. And the polling is tightening. I mean, there is a bit of a shift here. Now, whether this is a sustainable shift in Trump's, direction, I think remains an open question. We still tell our clients this is a 50-50 race. And this is going to come down. So whether polls have tightened by a point or 50 basis points, this is all, for all intents and purposes, with polling error the way it is, this is a complete dead heat. I've said a knife fight in a phone booth. Kind of a violent metaphor, but quite true in that this is just so razor thin, and it will come down to both turnout, but also those persuadable voters, and that's what you're sort of seeing, this final pitch, if you will, particularly on the Harris camp, trying to kind of convince those Nikki Haley voters, those folks who are on the edge, to come to her side.
I love that, a knife fight in a phone booth, because it's sort of what everyone feels like who's old enough to remember a phone booth. I just wondering, going forward, when it comes to turnout, what are you looking for to understand who has the upper hand there?
Yeah, so sometimes turnout can be predicated on sort of ground game and infrastructure. I mean, Harris probably has an edge there if you just look at the money and her field offices. But again, if you're just looking at kind of some polling in terms of demographics, Trump is doing well with part of that Democratic coalition. Those black men, I mean, there's a reason why that demographic has been getting so much focus, because Harris needs that cohort to win. Now, she will still win that for sure, but if she wins them by less and he loses them by less, then he may win. So this is why you're sort of trying to see, and she's really, I think, the final days and final weeks going to really lean into that cohort, Philadelphia in particular, trying to get that turnout to your question.
Libby, former President Obama made the case that it was misogyny, but actually the Democratic Party has been purging these votes from black men 18 to 45 since he ran, every single 4 years. What is the Democratic Party's problem with this group of individuals?
Well, look, I think that just maybe zooming out, the coalitions around parties are changing. And that has been something that has happened, for both parties. If you look at the complexion of the Republican Party, it looks very different from 30 years ago. And if you look at the complexion of the Democratic Party, which used to be, sort of non-college educated union workers, that's still part of the party, but it is morphed, and now they are depending on, college educated white women, for instance, more than they have before. So I do think it's sort of a broader, kind of paradigm shift, if you will. And to sort of the black man cohort, I think that they are, again, they're trying to make their final pitch about, why Harris is better for that cohort. Well, it sort of remains to be seen. I think people, where our clients are asking us, if you look at sort of just the economic data here, propeller heads here. Real wages are up over the last 18 months. Labor force participation, market is strong. So sort of for all intents and purposes, you would look at that on paper and think this is great for an incumbent president, for an incumbent party. However, it is that inflation. I mean, inflation, and even though real wages are up over the last 18 months, real wages are still negative since Biden's inauguration. I think that just seems to be hitting voters in a way, that gas and groceries that we have talked about, that will be the reason, if Harris loses, that will be the reason why.
Just quickly, are there actually people that haven't decided? I struggle to believe that. Surely they've decided.
Yes. And I would say the vast majority of people have decided. They decided 2 years ago, right? They decided, coming out of the voting booth in 2020. I mean, the reality is that our electorate is incredibly polarized and incredibly calcified, right? This is why you actually, and sorry about my advice about coming back and thinking that you're going to, after the summer, you'd be able to have some clarity. But that is why we have not had clarity. But to your question, yes, there are kind of two groups of people. There are people who are actually swing voters, who are actually deciding between the two. And there are folks who are deciding between one candidate and the couch, so to speak, staying home, taking care of their kids, making dinner, and not voting. So it's the persuadable voters, but it's also the folks who you just need them to actually turn out.
Libby, it's good to see you.
Good to see you.
Thank you. Libby Cantrill of Pimco from New York. This is Bloomberg. Equity futures on the S&P 500 up 0.2%, adding a little bit of weight to the rally over the last 6 weeks. We are looking at 6 weeks of gains on the S&P 500 for the first time this year. And the bullishness, take a listen to this from Scott Rubner over at Goldman. US stocks can finish the year well north of 6K. That commentary coming earlier this week. And from Bank of America, we caught up with Ocean Kwon earlier this week. As long as inflation remains in check, good news is good news, and that's the way it's been over the last 24 hours. Retail sales and jobless claims, better news.
Yeah, and basically not only retail sales and jobless claims, but you also see the actual earnings that are coming in stronger than expected. Time and time again, the message is clear. Consumers are not losing their spending power. And basically, as American Express's CEO just told us, what landing? We're not seeing a landing. We're still flying. And that's certainly what you're seeing reflected in a lot of, particularly the finance results.
So as that data comes in better than expected, at the front end of the curve, we're still waiting for interest rate cuts from the Federal Reserve. So even with that better data, the lift on the front end is just contained just a little bit. The flexibility is at the longer end of the curve, and that's what we've seen play out. 10-year yields just climb over the last 4 weeks, and again over the last 24 hours. Your 10-year up a single basis point this morning, 4.1%. So the curve is steepening, but this time it's steepening from the long end. That's a bear steepener. And people are looking for more of the same maybe if we get more economic data that comes in, surprising to the upside.
There's a little bit of a creeping fear of reinflation, although not necessarily runaway pandemic-style inflation. And you can feel that in the break-evens and the bid for gold. At the same time, how much is this a reflection of inflation versus a reflection of the deficit? And I know everyone's been talking about the deficit forever, but I've been reading an increasing number of notes saying the fiscal profile makes people a little hesitant to go into the long end of the yield curve. They continue to go into the middle of the range, or they'll go into the short end, and that's certainly what you've been seeing in terms of where the focus of the rally has been.
There's a number you hear a lot, 5, the belly of the curve. We'll talk about the 5-year. Further out along the curve, I'm with you. Election risk is real. And if you get some kind of sweep, you're going to see a lot of debt issuance. Even if you don't get some kind of sweep, we've had guests on this program say that either candidate, regardless of who's in power, regardless of the makeup of government down in Washington, D.C., no one's going to fix this problem.
Which, again, raises a question, when is the catalytic event that's actually going to create a problem in the markets, especially at a time where globally you're seeing a sort of gravitational force downward? One reason why I actually think it's so interesting to watch what's going on in Europe versus the U.S., at what point the bid into duration, the bid into longer bonds in Europe goes into the U.S. as sort of a relative play or not, if people really look at the deficit as an issue.
Well, let's push it through foreign exchange. The euro right now, 108.48, stronger by about 1/10%. The euro weaker for 3 consecutive weeks coming into Friday morning. We'll talk about the risk of hitting parity in just a few moments. So look out for that. 108.47 on euro dollar. Under surveillance this morning, Netflix adding 5 million subscribers in the third quarter, beating expectations despite impacts from recent strikes across Hollywood. The co-CEO saying the company's plan to re-accelerate growth, including subscription tiers, is working.
And I think the right question, and we were talking to Jason from Citi earlier, is what's going to ignite the further growth? He's talking about how they already have a critical mass in terms of saturation. You raised sports, and I think that that's actually one of the most important things. Can these streaming services, and led by Netflix, gain a foothold in one of the must-watch TV, appointment TV kind of audience? And that, I think, will be sort of key.
What's more must-watch than National Football League around Christmas time? And they're going to get 2 of these live programs. They're now getting boxing matches as well. People are signing up because there's no other place to go if you want to see that live program. But to Jason's point, it's the fact that they make the subscription base, that price premium, is now affordable for a lot of people. So even if you were kicked off because you were maybe sharing computers and they passwords and they have this crackdown, you can maybe now it's a little bit more affordable. And he says in Latin America, where they saw them make subscriptions a little bit more of a higher pricing point, they were starting to purge some of those subscribers.
Netflix this morning up by around 6%. Let's talk about the iPhone. The iPhone 16 sales in China are up 20% in the first 3 weeks. Counterpoint Research telling us here at Bloomberg that the Chinese consumer also continues to shift to pricier models, including the Pro and Pro Max, a positive sign after the tech giant saw slumping sales in the region for almost a year. Apple this morning, off the back of that report, Lisa, up by close to 2%.
This doesn't work with the other reports we've heard. And that's, I think, the most interesting aspect. I read this and I said, what? What is up with this? Is this idiosyncratic? Is this just that the comps from last year were that bad? That could be a piece of it. Or is this that we've overplayed just how much the Chinese consumer is decoupling from the U.S. and U.S. Actual aspects? Or is it that we overestimated how much technological prowess Huawei had to come up with a competitive phone? There are a lot of questions embedded in this in terms of how sustainable it is, especially as we get Procter & Gamble results that show that China sales are falling.
Dan Ives says they basically have their mojo back when it comes to Apple in China. And he put out a research note this morning that called it a renaissance in China. And he just got back from a trip from Asia. And he writes, supply chain checks. We believe China sales for iPhone 16 will show strong rebound over the next year with the beginning of this AI-driven supercycle model. And then he says maybe what Apple needs to do is team up with Baidu locally to make sure they could try to get some of that AI tech onto the iPhone.
Watch this space. Apple up in the pre-market by 1.9%. The US is pushing for a ceasefire in Gaza after Israel confirmed it killed Hamas leader Yahya Sinwar. President Biden saying, quote, now is the time to move on. It's time for this war to end. Secretary of State Antony Blinken making his 11th trip to the region in the coming days.
11th trip to the region, every single one before this. He's basically come back empty-handed. And we were speaking to Norman Rule earlier, who said the timing of this is interesting because maybe this will dictate when Israel will not respond to Iran. Potentially, if you are the White House and you believe what President Biden is saying is that this is a chance to, quote, move on, you would send Blinken there as just a way to potentially withhold Israel from retaliating on Iran right away, because they wouldn't do such an attack, the Secretary of State in the region.
There are a lot of moving pieces here. There was initially a hope that maybe if Bibi Netanyahu could have some sort of symbolic win, that he killed the leader, that he could create a ceasefire. At the same time, who's he going to negotiate with? And at a certain point, what is the ultimate goal? And I think that's what Norm Rule was getting at. And to your question of, is this sort of what the U.S. got into in the Middle East, in Iraq, et cetera? How much is there a lack of an end goal that has been articulated that can be worked on, that can actually lead to something that's lasting?
We talk a lot about who has the influence here. The United States. I think we need to talk about personnel. How much influence does Secretary Blinken actually have in this situation? And you alluded to it, 11 trips and hardly anything to show for it.
I'm not sure Secretary Blinken holds all the cards here, because this is an administration where all the deal making, all the decisions come out of the West Wing. If you ask sources stateside or around the world who they call when there's a problem, it's Jake Sullivan and his team. It's Brett McGurk. It's Amos Hochstein. Secretary Blinken is not the first call when there's an issue.
It's an important distinction, a really important distinction. Let's talk about foreign exchange. The US dollar heading towards a third week of gains after getting a boost from stronger than expected US retail sales and an ECB rate cut. Kit Juckes of SocGen writing, the market has been fed a steady diet of stronger than expected US data of late. More of the same will keep it bid, but perhaps mostly against the China-sensitive currencies where concerns about US tariffs and disappointment at fiscal easing aren't going away. Kit joins us now for more. Kit, welcome to the programme. We caught up with Geoff Yu, someone you know well, a little bit earlier this morning. He's looking for parity next year. Can you get on board with that?
I had this sense that we would get somewhere closer to 120, not that far, on this bounce on a US slowdown, followed by possibly a move to parity then, because the long-run story is difficult. The challenge right now is that the market has bought so many dollars. And when I mean the market, I don't just mean the foreign exchange market. I mean the capital inflows from everybody sucked in by U.S. yield, by U.S. tech stocks, by U.S. exceptionalism, U.S. outperformance overall over the last couple of years. So, the world's savings have gone to the United States. And I certainly thought 2 months ago that once you started seeing people forced to hedge those or reduce their risk, that would give the euro a bounce, or it wouldn't be anybody's favorite currency, but it is the world's biggest net investor abroad, so it makes a difference there. And then the problem would come back in 2-3 years down the road. I'm now utterly confused. Jeff's much cleverer than me, but I don't think we're going to get to parity on the way down now. I think we have to clean out some of the positioning at some point and get a more meaningful dollar sell-off before the U.S. economic outperformance can drive us lower. So in my mind, it's still a couple of years away. What we are now is, I think, the market completely wrong-footed by the U.S. economy. I mean, along with the Fed and everybody else.
Sure. So, Kit, let's talk about the difference between the Federal Reserve and the ECB. The ECB has also been surprised the other way. The ECB has been talking about data dependence, meeting by meeting. Do you get the sense the market's just in the driving seat making the decisions now for them?
The market certainly bullies them to some degree, in the sense that, you can kind of say, did the Fed go 50 because the market was talking 50, or did the Fed go 50 because they were really shocked by the data at the beginning of August? A bit, it's a bit of both. One hopes it's more the data that are doing it, but they might now think, yeah, if we'd seen the data since then, we wouldn't have acted. The Europe is a bit the same thing, but they've got, the ECB's big difference is it's only focusing on inflation, at least in principle, And to that extent, what it was getting, what it's now had is a surprising slowdown in inflation by its standards. And so it doesn't really have an excuse not to get on with easing. We've had 1 month of that, but you'd have to say we're going to get more rate cuts down the road because I suspect inflation will continue to fall because there isn't any growth and the global backdrop's changed. But they are all, yes, the market is pushing because that's what the market does. And the central banks are finding that when they get data that support what the market does, that they can't really resist the temptation of going with it.
As you said very diplomatically, Kit, we haven't really learned that much from ECB news conferences and whether it's being bullied by the market or the data. Either way, they've been sort of flipping and flopping in terms of their overall message. That said, there seems like there was a shift. And yesterday, what I thought was interesting was that not only was Christine Lagarde talking about potential weakness, but she made it political. She said that the potential of tariffs in the United States actually increased the risk of downside surprises to the area's struggling economy. How much do you see the ECB cutting rates aggressively to get ahead of whatever might be coming down the pike?
It's hard to imagine the ECB cutting rates aggressively. It's not in their DNA to do anything other than react to inflation. It's still, the job is to hit the inflation target. But I do think they can pick up the pace from possibly, let's put it this way, from what a lot of economists had expected, while not quite keeping up with the pace that's priced into the front end of the curve, because they are alarmed. It wouldn't take much more softer than they expect inflation data to push them into feeling that, yeah, look, we have no reason not to get a move on.
At the same time, Kit, on the flip side, there seems to be this assumption that if the U.S. puts up its walls and does increase tariffs substantially, that will end up with a stronger dollar and a weaker everyone else. And especially given your opinion about how much of an overweight there is in dollar assets, it seems like you disagree. Do you think that people are underpricing the risk to the U.S. economy in that type of scenario?
I think people are looking at the U.S. economy in all scenarios in a state of saying, we know the U.S. economy's done phenomenally well. We understand part of it was the size of the fiscal easing that we saw during the pandemic and immediately as the pandemic was ending. We don't understand why the tightening that came after that didn't slow the economy more. We don't understand how the economy's reaccelerated in the last 6 weeks. Hell's bells, let's stay with U.S. assets because, all the good stuff comes out of this place. And I think there's that kind of reluctance to turn around and say, well, where else can I put my money? The Japanese were selling U.S. debt, like crazy in back in July as they were trying to get out of some of their trades. They're right back in. They're buying with gusto again, and probably U.S. equities and so on. So, there's no. I think the market, investors are as much caught out by this unique economic cycle as economists or central bankers or all the rest of us. And the default is U.S. is a more resilient economy. It's growing faster. There are more investment opportunities. It's got higher yield. If I'm there, why should I cut back, pair, hedge my currency too much? I know I'm going to end up going back in later anyway.
Kip, ahead of the U.S. election, more people are talking about parity, even though I know you think it's a few years away. But you do say there's one trade that is definitely perceived to be safe pre-election, meaning regardless of either candidate. What is it?
Safe trades, Bria. You might have to tell me now. I'm feeling nervous this morning that nothing's safe. No, I think people see the safe trades as being still to be short the euro against various things, and a lot of people see the political trade to be short the yuan against everything.
Short the yuan because either Harris or Trump is going to be tough on China.
I think the piece in markets thinking about election trades at the moment is that you get bigger moves on a Trump event. So Trump he's more outspoken, and he's got clear intentions on things like tariffs. So if you think the odds of them are 50-50 for the sake of argument, you get bigger moves on Trump. You don't get moves the other way on Harris because she's less likely to get a clean sweep apart from anything else. So the market ends up concluding, I'll have my Trump tariff trade now because I'm not going to get hurt for having it. And rightly or wrongly, that is a very popular trade.
Kit, appreciate the update from you, sir. We're all confused. Kit Juckes of Societe, Appreciate it. Thank you, sir. Things have changed a lot. Think about where we were in the summer. You had jobless claims spike to about 250. You had that July jobs report in early August. Everyone's starting to freak out about a deceleration, a breakdown in economic growth in America, and maybe in the jobs market, much more so. And then you get that address at Jackson Hole from Chairman Powell, and it feels like, let's go, 50 basis points, and maybe a string of 50s after that. And then here we are. How much things have changed. I remember the commentary coming from people like Stephen Jen, super sophisticated, very smart individual that Kit knows well in foreign exchange, the author of The Dollar Smile. He comes out and he says, we've accumulated basically this massive long in US assets, this big search for yield, and that when you start reducing interest rates at the Federal Reserve, the money's going to go home, look for a home elsewhere, beyond the United States, and you could get some real dollar depreciation. That was only 6 weeks ago. 6 weeks later, economic data's better. The Fed maybe has to tap the brakes a little bit. We're talking about skipping a meeting, never mind going 50 basis points. And all of a sudden, we've got people coming on the programme talking up parity on euro-dollar next year.
Because ultimately, take a look at the U.S. data you put into the surprise index and how much we've seen it just absolutely skyrocket to the highest levels going back to April. I want to just quote the CEO of American Express. Nothing has landed. We're still flying, not at 48,000 feet, but we're not landing. The economy is still moving along and our cardholders are still spending. This is the rhetoric we're hearing from so many different people. So you've got to think the Fed's still cutting, but you got to imagine this is very different from what we're seeing elsewhere.
Is Torsten Slock doing consultancy over at Amex?
It
sounds like a Slock note.
I know. Well, maybe they're friends.
Let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Warren Buffett has sold more Bank of America shares. The lender recently purchased enough of its own shares to nudge Buffett's stake back to 10%, a regulatory threshold that requires rapid disclosure. According to a recent filing, Buffett's Berkshire Hathaway reaped about $370 million selling stock this week. The sale pushed Berkshire's stake below that regulatory threshold, but Buffett's conglomerate remains Bank of America's largest shareholder with a $32.6 billion stake based on Thursday's closing price. Next week, Vice President Harris will be joined on the stump by Barack and Michelle Obama. A senior campaign official tells Bloomberg that the former president will join Harris in Georgia on Thursday. The former First Lady will appear with the vice president in Michigan. It's the first time Harris has appeared with either of the Obamas during the campaign. First Lady Dr. Joe Biden also embarked on a 5-day, 5-battleground state swing this past week, stumping for Harris for the first time in her presidential campaign. And it was a tough night for both Anne-Marie and Lisa. The Mets dropped Game 4 of the NLCS to the Dodgers by a score of 10-2. They'll need to win the next 3 games or they will face elimination. And the Yankees lost Game 3 of their series in Cleveland after the Guardians stormed back to tie the game in the bottom of the 9th. David Fry hit a walk-off 2-run home run in extra innings to secure Cleveland's first win of the series. The Yankees take their 2-1 series lead into Game 4 later this evening. And that's your brief, John.
Danny, thank you. Appreciate that. As a neutral observer, of course, Mets aren't doing too well, are they?
Well, okay, that's not neutral. We already know your affiliation, first of all. And second of all, if you want to know why I'm tired and grumpy, that's the reason why. So there you go.
They're not doing too well. I went to bed and the Yankees were winning. Back-to-back home runs from Aaron Judge, Giancarlo Stanton, amazing. Then Cleveland
going.
Then Cleveland comes out. Cleveland comes out and has the audacity to say that it shouldn't count because they didn't think that Giancarlo foot hit the first base. It counted. Went to bed all happy. Woke up. Depressing.
No, that's good. Pretty bad.
Okay, we're done.
I think that's
all right. Good. All right. More on that next week, maybe. Up next on the program, looking for a bounce in China.
The renaissance of growth has begun for Apple with iPhone 16. I think China, look, that was the biggest issue. That was a headwind. Now it's a tailwind. They have mojo going into the next, I think, 6 to 9 months.
A conversation up next, live from New York. You're watching Bloomberg Surveillance. Equities firmer by 0.2% on the S&P 500. Under surveillance this morning, looking for a bounce in China.
The renaissance of growth has begun for Apple with iPhone 16. I think China, look, that was the biggest issue. That was a headwind. Now it's a tailwind. They have mojo going into the next, I think, 6 to 9 months. And that's why, look, a lot of the bears, they've yelled fire in a crowded theater for the last month. But I think they go back into hibernation mode, in our opinion. When you look at iPhone 16, this is globally going to be the start of an AI-driven supercycle.
So here's the latest. Counterpoint research fueling hopes China's consumer is bouncing back, indicating sales of Apple's newest iPhones there are up 20% in their first 3 weeks compared to last year's model. Oliver Chen of TD Cowen remaining cautious on luxury retail, saying we lower our organic sales estimates across the board, given uncertainty around the China turnaround and continued pressure on the consumer. Investors and management teams originally anticipated a second half recovery. That is yet to materialise. Oliver joins us now for more. Oliver, what happened to that second half recovery? LVMH is still saying things are bad. The latest research on Apple says things are getting better. Where's the truth lie?
Yeah, Jonathan, in the luxury sector, particularly in apparel and aspirational goods, this has been cautious and it will continue to be. The housing market and consumer confidence, as well as low unemployment, it's really weighing on this Chinese consumer, and that's affecting all other luxury stocks, in particular Kering Group as well. LVMH is one of the biggest and the best and the most solid and has a lot of marketing budget, but this has had issues too. So it's something we've been seeing and watching, and a lot of these issues are more structural in China, so it'll just take time. That being said, LVMH, we still recommend it as outperform rated. We think the balance sheet, as well as these power brands, Louis Vuitton, as well as Dior, are great strategies for the long term. But the near term is going to be bumpy because of the housing market issues and valuation there. That'll take a little while to recover.
Oliver, how much are we seeing a troughing out, though, in the story that Chinese consumers don't really want to buy brands that are not Chinese?
Well, aspirational really matters, and these brand stories and the heritage of luxury really matters as well. Also, luxury is a very concentrated industry with the top brands taking the lion's market share. That being said, our survey work does indicate strength of mainland China brands as well, and the emergence of smaller brands too. But luxury really holds a special place in terms of the hundreds of years heritage of brands like Hermes, Dior, Vuitton, and also the story around craftsmanship. And don't forget, luxury is very emotional, and paying this much extra for a bag or jewelry, it really has to do with the storytelling as well. And America has great stories too in terms of our brands as well.
Oliver, quickly, what does LVMH have that Kering doesn't?
Yeah, LVMH has a very diversified portfolio. So LVMH has Tiffany as well, and Sephora. Beauty's been quite powerful. Kering, the portfolio is more orientated towards soft luxury goods, such as Gucci and Kering, and Gucci and Saint Laurent and others. Bottega Veneta is doing quite well, but Gucci is the big brand that matters at Kering, and this brand's in a turnaround. It's really returning to timelessness and re-elevating the brand, which is a great strategy. But overall, a couple things add risk to Kering. A, the Gucci turnaround. B, these brands are more aspirationally focused, and that's been a tougher customer as well post-stimulus.
Hey, Oliver, it's good to catch up, sir. Next time, come in the studio. Oliver Chen of TD Cowen. Appreciate it. I think the right way to frame that is what Kering has that LVMH doesn't, and that's the problem chart that is Gucci, as he explained. Up next on the programme, Drew Pettit of Citi, Matt Bryson of Wedbush. We'll catch up with Lindsey Piegza of Stifel and Mike Schumacher of Wells Fargo. The third hour, up next.
At end July, we didn't need a rate cut. Mid-September, we needed a 50 basis rate cut. And now we're talking about caution on rate cuts.
But this market keeps changing narrative.
People might say they're bearish, but when you look at the positioning and look at their equity exposure, it's still relatively high.
A month ago, we said that investors were nervous bulls. Now they have just become bulls.
It's become a good news is good news, bad news is bad news type of environment.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. You're opening about 90 minutes away. Your scores look like this. On the S&P 500, firmer by 0.2%. On the Nasdaq 100, up by 0.5%. Thank you, Apple. Talked a lot about that name. Just where is this US consumer right now? Retail sales says things are totally fine. Procter & Gamble reporting some softer sales growth, but ultimately saying the core of the business is still okay. And Lisa mentioned Amex. Amex lifting its full-year guidance. Consumers doing better than good.
And we've seen this across the financial space. And to me, I thought it was fascinating that the American Express CEO said that this economy is not landing. Maybe we're not at 48,000 feet, but it is still flying and the consumer is still spending. The fact that they're willing to pay money for a premier credit card, you could say, okay, this is just the higher income consumers, but you actually see this across the different sectors. This is an economy doing just fine.
We beat our own expectations and the street too, raising guidance. We see nothing wrong with the fourth quarter. Keep calm, carry on. But to your point, American Express is really for the upper income cohort. What about those on the lower income? Yes, they're still spending, but are they making more, as we've seen from a lot of earnings reports, judicious, more cautious decisions?
Just as you process that stock move on the screen, stock is down 2.5% at the pre-market. It's up more than 50 for the year so far. It's positive by 52.55% year to date. Put that together with some of the financials, the banks, the financial system in America. I know a lot of people might be worried as I say this.
Yeah.
Seems to be okay compared to what we've seen so far.
I think we could take this a step further. I actually think one of the most interesting aspects of the financial earnings season is the willingness to lend and the capacity to lend and the room to do so at a time where you already have strength. Essentially, this is not only a consumer that's okay, but any kind of incremental rate cut is going to help that lower cohort more and more directly. And suddenly there is a more willingness to lend even at the regional banks because they have some money freed up. This to me speaks to the question of how much of a reacceleration could we get and the inflationary read-throughs from there.
And even with all of that, people still think the Federal Reserve will cut interest rates on November 7th, regardless of what the economic data looks like between now and then.
There's just this quiet transitory that people aren't going to say, that maybe it really was transitory, that maybe these were pandemic-related shocks, and that we can get disinflation at the same time as a reacceleration in growth because there are these sort of, yes, maybe stickier inflation, but not necessarily the runaway that we saw with the excesses from the pandemic era.
Transitory on steroids, okay? Like extend the timeline. I remember that whole argument. It'll last a few months and then it'll fade.
Okay.
Come on.
No, transitory in a lifespan, what does that mean? A couple years
By
between
definition,
friends?
life is transitory. Coming up, Drew Pettit of Citi as Wall Street dials back rate cut bets. It's true. Matt Bryson of Wedbush as TSMC results continue to lift chip stocks. And Lindsey Piegza of Stifel on the strength of the US consumer. There's your lineup. Let's see if we can get through this hour. We begin this hour with stocks steady as investors dial back Fed cut bets on the back of better than expected economic data. Drew Pettit of Citi suggesting valuations are full. The solid expected fundamental backdrop has to be considered against the valuation setup. The bar is high. Index multiples are all at top decile levels. Our implicit growth framework in aggregate leaves little room for missteps. Drew joins us now for more. Drew, welcome to the programme. It's good to catch up again. Is this index level analysis, Drew? And if you break it down sector to sector, is the bar higher in other sectors compared to others going into earnings season?
That's the beauty of index math, right? It can look a certain way at the index level, but there's opportunity under the surface. And honestly, I would say the growth side of the market definitely has the higher bar. We kind of see that in reactions after earnings reports. And the value, especially the cyclical side, we think has a little bit of a lower bar. So there is a little bit more margin of error on that side of the ledger.
Drew, is that why you like energy and financials at the moment?
Yeah, like to be honest with you, there's not much growth priced in there. And when you look at the bank's reaction to earnings, it was generally really positive. Even when we think about something within industrials like transports, which we upgraded to market weight, you see better results to beats and raises than you do see, I would say, reaction to misses. I think a really good example there is looking at Delta, who did not post a good quarter. It had a very small drawdown and then resumed its uptrend. And then you look at United, who posted a great quarter and had a massive move on the back of it. So I would say, like, you could see that implicit growth setup basically explaining some of these moves after results.
But Drew, how far does this have to run? I mean, we're talking about the growth sector. A lot of good news has been priced in. And they've actually beat again and again with some pretty astronomical beats. And this sort of secular story of AI adoption seems to have no limits when it comes to NVIDIA. How much runway is there in something like financials at a time of constraint on the regulatory side and some real questions about exactly the path of the economy?
So look, you might feel like it's a tactical trade, but how the tactical turns into something a little bit more structural might actually rely on the Fed. Now, this relationship isn't causal, but I find it interesting. We don't always talk about the correlation between S&P 500 and cyclical's earnings growth is actually higher to Fed rate cuts than it is, well, then I'd say rate cuts are to valuations. Where it gets messy is when the Fed starts cutting, kind of like what you guys were talking about just before you introed me, but the economy and earnings growth hangs in there. That's how you get upside to markets. That's how you basically shoot past our target and get more of a bull case for the S&P 500 and the cyclicals.
I'm buying all of this. Makes a lot of sense. Here are other people who get on this. Energy is another story. Energy is sort of this question mark. When we ever ask people about energy, I just hear this sigh. Well, it's supposed to work because you sort of, theoretically, if you get an acceleration in the economy, it should trickle into the energy sector. You've got everything going on with AI and the power usage. Why is that story not working as well as so many people thought that it would?
I would say that sigh that you hear is the same sigh that we hear. We've probably had more clients tell us that oil's more likely to be at $50 a barrel before 80. So again, very, very, very low bar there, low implicit growth expectations. But what really changed in 15 and 16 is these companies really focused on spitting out free cash flow, not over investing. So again, energy might feel a little bit more tactical. Yes, very commodity driven. But in the background, you got companies, especially the major oils, that are just spitting off so much free cash flow at lower dollar levels of oil.
So, Drew, as you've pointed out, there's not much space for error here at all going into year end. And yet you also acknowledge there's some big volatility events coming up, including the election in early November. Drew, why do you think we're rallying into that? Are you surprised that we haven't been a little bit softer going into that?
A little bit, to be honest with you. I would say coming off the highs in kind of mid-July, I think gave some investors a comeback into certain sectors that have run. Honestly, semiconductors is probably a really great example, an area we upgraded. Maybe it's your last good chance to get in. And then the other piece is earnings. As much as we like to talk about short-term volatility events and valuation setups and so on, long run, earnings direction is really going to power the direction of the market. So I'd say to the upside, it's been earnings and honestly some opportunities to get into some secular winners on pullbacks.
Drew, there's a lot of uncertainty, as Jonathan mentioned, surrounding the U.S. election. BNP Paribas this morning coming out with a note basically saying they're too expensive to hedge. That's why the hedge is unattractive. Would you agree with that?
To some extent, maybe. But maybe if we're not talking about outright hedges, I would say there's actually some longs you can engage in to kind of hedge some of your risks here. Look, if you're worried about tariffs, there's a lot of U.S. manufacturers and reshoring, nearshoring, and so on, some themes you can play there to the long side. If you're worried about valuation and what, I would say debt trajectories might do to what you're willing to pay for the market, there's a lot of stocks, self-help stories, and recoveries at pretty low valuations you can buy. There's still a lot of opportunities under the surface for people here because the rally really, until just the past few months, has been so narrow for 2 years.
And opportunities like the ones you just gave an example of, if you're worried about tariffs or worried about the deficit, you can put on for either candidate?
Yeah, I think there's opportunities. And honestly, on top of that, there's a lot of secular trends and themes in markets that aren't going to really be upended by either candidate. Do you think we're going to sit here next year and talk about AI and tech innovation and productivity not being a thing? Yeah, maybe something on the fringe changes the slope of that trajectory, but it doesn't inflect it. So I think there's a lot of really good secular stories people can buy into, regardless of your view on the election.
Drew, I love that we get to speak to you because you actually look at all of the balance sheets and try to understand the C-suite and what they're doing. And one thing that is really still a question mark for me is going forward, how much is this resilience, reacceleration, particularly in cyclical areas, going to lead to a higher inflation level? How much are you seeing pricing power come back to companies after, I don't want to even say dormant, it wasn't dormant, it was just sort of a little bit quieter for a couple of months. Is it really coming back?
Honestly, I'm not sure it went away in the S&P 500, to be honest with you. One of our themes for the whole year was show me the money, basically who could generate free cash flow. And a ton of these companies are still doing it. And part of it was looking for companies with operating leverage. And there's a ton of that in the S&P 500. The beauty of higher margins for some of the higher quality large caps has been they could absorb some of the higher, call it cost inflation, and pass it through. So look, margins have not been dented. We still think there's some room for margin improvement ahead. So really, like, I'm not too freaked out about pricing power of the S&P 500. And inflation, to be honest with you, is not necessarily a bad thing for companies that have positive earnings and positive margins.
We lived through that. Drew, it's good to see you, sir. As always, Drew Pettit there of Citi on the latest. Just how low or high this bar is going into earnings season through the next few months. Equity futures on the S&P 500 positive here by 0.2% as we count you down to the opening bell with an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Secretary of State Antony Blinken is headed back to Israel. President Biden said he would send Blinken as part of an effort to end the war with Hamas following the death of its leader, Yahya Sinwar. This will be Blinken's 11th trip to the region since the war broke out last year. Israeli Prime Minister Netanyahu said Sinwar's death doesn't mark the end of the war in Gaza, but it's the beginning of the end. CVS is ousting CEO Karen Lynch and appointing David Joyner as its next chief executive. Joyner previously led CVS Caremark, the company's pharmacy benefit business. The announcement also came after CVS repeatedly missed its earnings target, setting off unrest among shareholders that spilled into public view in recent weeks. The company also said that this year's third quarter results will fall short of Wall Street expectations. And American Express shares trading lower this morning, 3.4%, despite a strong showing in its earnings. Amex full-year guidance again delivered better than expected results. The report showed higher spending consumers are turning to credit cards with rich rewards. The shares, however, are at a record, and they did increase provisions from credit losses, $1.4 billion up from $1.2 the year prior. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the programme, the morning calls, plus we'll catch up with Matt Bryson of Wedbush on why he sees no end in sight for AI demand on the back of TSMC results. That's next. The opening bell 1 hour and 15 minutes away. Equity futures up by 0.2 on the S&P, up by 0.5 on the Nasdaq 100. A little bit of a lift across the board here on the Russell. The small caps up by 1/3%. On the week, the Russell doing okay. We're up by about 2%, the best week since September. Up 2% on the small caps. If you switch up the board, turn the page and get to the bond market story, I want to talk about a 10-year yield of 4.1%, adding another basis point to that move and staring down the barrel of a fifth week of high yields on a 10-year yield. Yesterday, off the back of retail sales, really strong retail sales. This is what Neil Dutter of Renmark had to say on those retail sales. The broader story here is that core sales are running well above the pace of nominal incomes. It is tough to see this strong pace of consumption persisting into the coming quarters. There are still doubts after yesterday's data.
Yeah, and Neil would be one of the people who would doubt because he thinks that the economy is more fragile than many people are giving credit to, and that the Fed needs to get ahead of the curve a little bit more. Key question here, though, is going forward, are we going to start talking about just how much the Fed can cut and whether this market is overplaying Fed cuts next year if American Express's CEO is correct in saying this economy is not landing, it is still flying, consumers have spending power, and we're seeing that reflected in a lot of results that we keep getting.
Joining us in just a moment, the opinion of Lindsey Piegza of Stifel. We'll catch up with Mike Schumacher of Wells Fargo as well. Let's take the opportunity to get you some morning calls. First up, JP Morgan raising its price target on Netflix to $8.50, expecting more balanced growth in 25 as its ad tier builds scale. Next up, Wedbush reiterating its outperform rating on Apple. Analyst Dan Ives highlighting the company's robust iPhone sales in China. That stock is up by almost 2% in early trading. And finally, Bank of America raising its price target on Nvidia to $190, citing confidence in its competitive lead in AI chips. We're up another 1% on Nvidia. Sticking with the chip makers, TSMC's better than expected results lifting chip stocks higher, including competitors like Nvidia. Matt Bryson of Wedbush saying there is, quote, no end in sight to AI-derived strength, lifting his price target on TSMC and reiterating his outperform rating. Matt joins us now for more. Matt, welcome to the program. I want you to help us understand, and particularly me who's still confused by it all, the difference between ASML and TSMC. I understand they do slightly different things. One makes the machines, the other makes the chips. But Matt, In your opinion, what explained the difference in very, very different earnings?
Yeah, I really think there's two things. One is that you look at NVIDIA and you look at AI, and there is, there is substantial demand for AI into 2025. Now, having said that, there's three chip makers who make advanced production. You've got TSMC, you've got Intel, and you've got Samsung. And I think TSMC is doing extremely well. I think both Intel and Samsung are struggling a bit. The second piece, I think, relates to China. So China has been ordering chip equipment in excess of their needs, in part because of concerns around the potential that they might not be able to get that equipment moving forward because of restrictions on exports. And it looks like that's finally normalizing. So when you look at ASML, they have multiple customers. TSMC is strong. A couple of those other customers, Samsung and Intel, are a bit weaker. But also on the China side of things, it looks like that those China orders that have been coming in ahead of expected restrictions on chip equipment exports, that those are finally slowing, and they've been helping ASML up.
Matt, can we talk about NVIDIA as well after you've explained that? Let's just sit on that company. We know where that demand is coming from. We've got a pretty decent idea of who their biggest customers are. So can we talk about their biggest customers? Do you think the investors in their customers will maintain the level of patience they have with the current investment cycle into next year if they're unable to demonstrate bottom line, top line growth off the back of the investments they're making sometime soon?
No, that's a fair question. So I think what we have right now is it's a question of is this generative AI move, is it 4G or 5G, right? So with 4G, we saw 4G enable a whole set of new applications, which in turn explain the investment in 4G, right? Without 4G, you don't have YouTube on your phone. You don't have TikTok. With 5G, you didn't get a whole lot. And so we saw kind of investment peter out. I think with AI, what we're waiting for is what is the application? So we still don't have Blackwell. So what does Blackwell enable? We still don't have ChatGPT-5. What does ChatGPT-5 enable? And I think we're going to have to see what those innovations turn into before answering that question. And if ChatGPT-5, if Blackwell is 5G, then we will see investment peter out. But if it's 4G, and I do indeed think that at some point it is 4G and the next set of applications are built on generative AI, then you will see the revenue turn up and you will see continued investment.
Matt, one thing that's sort of surprising to me, especially as we talk about the applications of AI, is why we've seen such a massive divide in the chip sector between the AI-related themes and industrial and auto-related themes, given the fact that they should intersect, right? I mean, shouldn't AI essentially be connected in some capacity to the technology in everyday items? How do you sort of bridge that gap? How do you understand how isolated these different chip sectors can remain?
I don't think they can remain isolated. So at the end of the day, when I'm thinking about what generative AI does, so certainly you can have enterprises that are benefiting from applications where TSMC, for instance, they will tell you that AI is improving the productivity of their tools. And that doesn't impact autos. To some extent, it doesn't impact industrial. But at the same time, I think eventually what you need to see with generative AI is I have to have an application on my handset that I can access that makes my life better. Or when you're thinking about autos, if Tesla can get their robo-taxi to work and their ADAS is AI driven, then yes, it certainly changes how you buy your automobile and creates a new wave of demand. So I think eventually those pieces need to intersect. But I think right now it's more about building out the infrastructure. And again, if we get ChatGPT-5 and changes the world, I think that certainly we end up in that situation where you end up with those end devices seeing more demand. But right now it's about building out the infrastructure.
Matt, we were just speaking with Drew Pettit of Citigroup, and he was talking about how the growth areas, and he included the likes of NVIDIA and some of the bigger tech names, have just been on such a hot trajectory and have been increasing and beating, and they really kind of are running out of steam, right? They're not going to be able to beat by the same kind of levels as they have over the past few years, which is the reason why he sees it as a less attractive area. Do you agree with that assessment? Do you think that the revenue surprises are going to be a lot lower than they have been over the recent years?
I mean, certainly you look at the magnitude of beats that we've gotten from NVIDIA, and there's a lot of large numbers. And at some point, those beats have to reduce. Again, though, I think it comes back to we will see the next wave of applications built on generative AI. It's just a question of timing. And so if those applications come sooner and you really start moving value from whether it's the worker in some sense into the data center, then those beats will keep on coming. If it takes a little bit longer, then yes, we could see a pause before. Again, I still think that eventually the next wave of applications end up built on generative AI. You see efficiencies, and people will pay for those efficiencies shifting from the workforce to the data center. And so I think there's another wave of growth. I think the real question is, if we get to the end of 2025, are we seeing that wave of growth, or do we get a pause into 2026? But certainly, I think everyone's investing in Blackwell. You will get beats through Blackwell, and then we'll have to see where we're at.
Hey, Matt, appreciate it, sir. It's good to catch up. Matt Bryson there of Wedbush, just breaking down the difficulties of explaining what's happening in the industry at the moment, the difference between, say, an ASML, big China effect there, and what you might see from a TSMC and further down the road from an NVIDIA as well. And you pointed to the pocket of strength and the pocket of weakness right now for some of these chip makers.
It's a really motley kind of picture. I mean, the idea that China was trying to get ahead of some potential restrictions, and maybe that's tapering out, but then also anything that has AI anywhere close to its name is, oh my God, yes. But anything that's related to auto sales, not so much. And industrials, we see that with Intel. So at what point do we start to bridge these gaps? Because ostensibly, it needs to be applications that get used in real life. So there should be some crossover.
After November, there's a real chance that life gets harder for some of these names.
It already is. There's a report this week from the Information about how the Commerce Department is looking at the TSMC and whether or not they're giving some of these chips to Huawei, and they're not supposed to.
Up next on the programme, we'll catch up with Lindsey Piegza of Stifel, Mike Schumacher of Wells Fargo. Your equity market up 0.2% from New York. This is Bloomberg. We are looking for a 6-week winning streak on the S&P 500, the longest weekly winning streak of the year so far. If we can close in positive territory on the S&P 500, up by 0.2%, on the Nasdaq 100, up by 0.5. As we count you down to the opening bell, let's get you some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John, a really tough morning for CVS. Shares down 10% in the pre-market trade. They've been under tremendous pressure from shareholders with poor results. Well, we learned that yesterday they ousted the CEO, Karen Lynch, putting in David Joyner, who currently, before this, headed up Caremark, just emphasizing how tough things are for CVS and why the board made this decision. Their third quarter earnings, they warned, are going to miss estimates, also pulling their guidance for 2024, hence the big slump in shares. On the other side of things, late yesterday, after the market bell, it was a strong showing from Netflix, up 6.33%, adding some 5 million customers over the quarter, beating on essentially every single metric, which is impressive given this company was dealing with Hollywood strikes. The concern among analysts, can it keep going if the boost from password cracking down is already over? Finally, ending it with Amex. The declines you're going to see here do belie what the actual numbers were. So 3% lower in the pre-market trade despite 6% gain and more people signing up to their cards, better revenue, better fee generation, upgrading their forecast. But keep in mind, this stock just yesterday was trading at a record high. It's up massively this year, and they also had higher marketing costs, more write-offs, more loss provisions. So, John, it just might be a case of a high bar for Amex.
Danny, appreciate it after a massive rally, which is what we mentioned a little bit earlier this hour. That stock absolutely flying through 2024. Elsewhere, good news is very much good news for equities. Retail sales report adding to the picture of a strong US economy, fueling bets that the Fed is on its way to a soft landing with a possible pause in easing. Lindsey Piegza of Stifel writing this: any additional indications of underlying strength amid sticky inflation will lessen calls for a 25 basis point cut next month, or even allow the Fed to bypass November altogether. Lindsey joins us now for more. Lindsey, welcome to the programme. Do you think this economy is re-accelerating, and do you think we're very close to this Fed skipping a meeting?
Well, I do think that yesterday's numbers showing this ongoing resilience and strength of the consumer reinforces the notion that we are on very solid footing. And when we look at what the retail sales numbers are likely to do to third quarter growth, that would be an acceleration above 3% from what we saw even in the second quarter. So this does, I think, do two things. First, it calls into question the Fed's decision to make that outsized rate cut in September, that 50 basis point reduction. But it also now calls into question the need for additional rate cuts, at least in the near term, as we look out to that November policy decision. I do think any further indications, as I said, with a few data points between now and then, any further indications of ongoing strength, further strength in the labor market, on the consumer, a re-acceleration in inflation, does give the Fed an out to potentially bypass that November meeting.
So, Lindsey, as you know, they're talking about removing restriction, not providing accommodation. And you can tell me if that's a distinction without a difference or not in just a moment. But ultimately, when they say recalibration, it feels like they mean autopilot on the way down to neutral. Is that the wrong way of thinking about this?
Well, I do think there's a very important distinction. And unfortunately, I think the Fed sent the wrong message with a 50 basis point cut. It was an inappropriate message to the market to suggest that they were in a rush to not only get back to neutral, but potentially below to provide support to an ailing economy, as opposed to a softer 25 basis point cut, which would have indicated that the Fed is simply removing policy firming at a slow and tempered pace back towards neutral as the data neutralize. So even if the Fed intended the latter, the message was muddled with that outsized rate reduction of 50 basis points. And now the Fed is caught in a position where they're trying to backpedal and not only recalibrate market expectations, but now determine what the appropriate next step will be after that outsized cut.
That said, Lindsey, a lot of people are looking at the growth and potential reacceleration of the U.S. economy and not seeing it get accompanied with inflation really picking up in a material way. We're not seeing that in break-even rates. We're not seeing that in a whole host of other metrics. So at what point do you actually see inflation reaccelerating in tandem with growth, given the fact that there are some reasons for inflation to keep declining?
Well, we are seeing some underlying metrics reaccelerate, push further away from the Fed's 2% target. The core PCE, for example, ticked higher. The supercore also ticked higher. But you're right, 0.1 of a percentage point is not necessarily an indication of a massive reacceleration of inflation. That being said, we're not at 2% yet. So I think the onus is still on the Fed, not necessarily to avoid a reacceleration, but to foster further improvement in inflation. The Fed's job is not yet done, and a reversion back to 2% is not a foregone conclusion. So the Fed, motivated by this fear of impending weakness in the labor market, shifted their focus away from inflation. Now we see that the labor market strength appears to be well-founded, and the focus of the Fed should go back to getting inflation under control. Remember, a soft landing is not just about maintaining positive growth, but reinstating price stability at 2%. And we still have quite a ways to go before we can achieve that goal.
This is so interesting, Lindsey, because essentially you're making the argument that maybe the Fed should take more of a page from the ECB and having more of a single mandate in terms of inflation rather than focus so much on avoiding some sort of weakening in the labor market. I just wonder how often we've seen this, where it's basically experiments on either side of the Atlantic, where one, the ECB, pledges to just focus purely on bringing inflation down, even in the face of economic weakness. And the Federal Reserve, to avoid any further weakness, says inflation's coming down, that's good enough for us, we're cutting rates.
Well, I do think that the Fed decided to move its focus away from inflation prematurely. Remember, when we look at historical cycles, the Fed has been forced to raise the Fed funds rate above, historically significantly above, that peak in inflation. So at 5.6%, 5.5% on the Fed funds rate was really the bare minimum that we should have expected in terms of this rate hike cycle. But given the massive amount of liquidity and stimulus and cash pumped into the market, it was really unreasonable to expect that the bare minimum would be the appropriate amount of policy restriction to reinstate price stability. So I do think that the Fed stopped short of where we needed to be. And now, to add fuel to the fire, they've reverted to this policy pivot prematurely before really seeing that underlying disinflationary trend take hold. And that leaves us in a very uncomfortable position as growth remains solid for now. If we do start to lose momentum looking out to 25, 26, and the Fed continues to tolerate above target inflation, the biggest risk for the U.S. economy longer term then is not a downturn like we're seeing necessarily in our developed counterparts abroad, but a period of stagflation.
So, Lindsey, though, is there a chance if we continue to grow and we do see inflation continue to come down, even though you do have concerns about maybe a reacceleration, is there a chance we could just grow bigger and not hotter?
Absolutely. And I think that's the utopic scenario that the Fed is looking for, that we continue to see this acceleration in underlying growth, resilience in the consumer, positive spending, and positive acceleration in the labor market at the same time that price pressures begin to wane back to 2%. But again, that's a big gamble, a big bet, when we haven't seen that established downward trend in price pressures. We're still seeing very sticky components, sideways movement in the core for 1 month, then, as I mentioned, a reacceleration more recently. And we're also seeing some of these upside risks to inflation that are still hanging out there. International factors that could disrupt commodity markets and lead to higher prices, energy prices, fertilizer prices, factors that are outside of the Fed's purview, not to mention a very contentious election coming up in November. And regardless of which side of the aisle we find ourselves on, either candidate is proposing expansionary fiscal policy, which will continue to complicate the Fed's ability to get back to that 2% level of inflation.
And possibly contribute to higher yields. Lindsey, we've got to leave it there. Thank you. Lindsey Piegza there of Stifel. Yields were a little bit higher on bonds moments ago. They've dropped now by about a basis point on a 10-year to 4.08%. We had housing starts and building permits data come in a few minutes ago, coming in just a bit softer than expected. We're down a basis point at the front end as well on a 2-year at 3.96. On the bond market, Mike Schumacher of Wells Fargo joins us now. Mike, we've got a 10-year sitting comfortably at 4%. And welcome, as always, sir, to the programme. Is the path of least resistance down towards 3 or up towards 5?
Problem, John, is you've got this incredible event coming up in a couple weeks, and it's basically binary. So once we get past the election, I think it's reasonable to talk about the long-term path, which we think is probably lower. But if there's a sweep, as your previous guest just talked about, let's say it's Republicans or even Democrats, doesn't matter so much, then we do think the path in the near term will be upward. So it's very, very much contingent on the election outcome.
Mike, why is it so contingent? We have a lot of people come on this programme still and say it's just event risk, and once it's cleared, we'll get back to business. Why is next year so election dependent for you?
It matters a lot to us because the spending profile is a huge issue. So think about a sweep, more likely to be Republican than Democrat, but it's really not a very different calculus. Unified government, much less fiscal constraint. I know, hard to believe when you've got a deficit of 6% already of GDP, but take that up to 7 or 8 or something like that. The market's going to price more debt issuance, probably higher yields, probably a steeper curve. And it takes a while to unfold. We think the path is actually slower if Kamala Harris leads a Democratic sweep because, frankly, she's not been in that seat before. So people in the markets will want to see her act as president for a couple months, get a better read on the policy path. So I think the legs in terms of yields going up in that case, John, that could go out 5-6 months.
So, Mike, a lot of people have been making this argument, and I buy it on its face. But as we've said before, this year has been the year when logic goes to die. And so I do wonder whether we're discounting the fact that, look overseas, actually, rates are coming down and yields are going lower in the Euro region, especially in the face of slower growth. Why wouldn't the U.S. be immune once again to any kind of real increase in yields on the heels of an increase in the deficit, which we've seen for many consecutive years now, if the U.S. is growing more, if the U.S. is the better rate story, if you have the dollar that still is the preeminent currency?
Let's think about the difference in the fiscal backdrop, Lisa, between Europe and the U.S. So Germany, for instance, the economy is not doing well. A lot of pressure to reduce spending, probably ill-timed, but nonetheless, that's the pressure. France, a lot of people thinking, oh, downgrade, that's a bad deal. We don't want that. Let's consolidate some as well. So the takeaway from the two biggest European economies is less spending, less fiscal support. So yes, that can push yields down. And eventually, if yields go down enough overseas, you're not going to shed that correlation entirely. They could pull U.S. rates down, but it's a very different fiscal picture. So the reason you can have that gap increase, let's say between the 10-year Treasury and the 10-year Bund, is much more spending here, and the path is toward lower spending over there.
At what point will potential volatility in benchmark yields filter over into the equity market? Will it have some kind of influence? Or frankly, are these two markets decoupled in a different kind of way simply because any increase in the deficit will actually probably help some of these companies?
Yeah, we get this question a fair amount. People will say something along the lines of, where is that tipping point? So whether it's in fiscal metrics, debt to GDP, or spending relative to GDP, and translating that into bond market volatility, it's really been hard to pick that out with respect to the equity market. One of the big mysteries, I think, for the year has been interest rate volatility generally has been very high, FX volatility low, although it's come up, and equity volatility, for the most part, has been low, although it's come up somewhat. So how do you get those to converge? Is it more volatility out of bond land? Probably not. Is it a much more calm bond market? Perhaps. But there's not a magic recipe at this point, I think, for that difference in the volatility regime to narrow. So I think we have to wait that out for a while.
Mike, what is it going to look like when we don't know, likely, the result of the election days or maybe even weeks after?
If it's weeks, it's pretty simple. One word, ugly. And think about 2000. People love that template. S&P was down, what, 7% in 2 weeks, something like that. That's a pretty bad scenario. And bond yields plunged during that time. So if it's a week or more, I think it gets pretty nasty. And I would say, think about Election Day on the Tuesday. If the result is not clear by the weekend, I think markets get very nervous. I've run this idea by a few of our equity folks. They say, no, you're optimistic. We think it's going to be just a day or two. And the markets really get very, very twitchy. So probably a much shorter time horizon than we had back in 2000, but a pretty nasty result if it's not really clear quickly on November 5th.
But 2020 in itself was just a few days. Shouldn't that be the base case?
I think you have to expect a couple of days because there are more delays built into the system now than we had back in 2000. You think about absentee balloting, it's not going away. If you look at the rules for recounts in a lot of states, they allow for a number of days to occur. So in my view, it's going to be a few days and the market can tolerate it. But again, if you get out to that Saturday, Sunday evening time frame and it's 5, 6, 7 days, I think the risk appetite is going to be very, very low. People want to get out of the way.
So define ugly. Risk appetite, meaning for stocks, not necessarily for bonds. That you could see that become the haven again. Is that correct?
That's right. Yeah, I think you'd see a big influx into bonds, primarily into the U.S. short end probably, so 2-year, 3-year Treasury, that sort of thing. Yields go down 30-odd basis points in the 2-year over the span of a week. 10-year yield drops probably 20 basis points, something of that sort. So big rally, big steepener, but again, it takes a few days to develop.
Mike, appreciate the update, sir. Mike Schumacher there of Wells Fargo on the latest in this bond market. Lot to unpack there. I think number one for me at the moment is just the difference between the United States and Europe. Europe, worse data. US, better. Europe, more cuts. US, potentially fewer. Europe, fiscal prudence. America, fiscal imprudence. Throw in tariffs and yields could go the other way even more. The spread between the US and Europe, let's take the 10-year in America versus the 10-year German Bund. We've seen about 40 basis points of spread widening over the last 1 month. So that's when the Fed cut 50 basis points, 40 basis points. Why? Because of everything I've just said and some.
So here's the question. At what point do those higher yields in the United States attract European investors to try to capture that? The sort of transmission mechanism here is the dollar. At what point do people not want to go into U.S. assets because they're worried about getting repaid? And as that actually becomes a concern, then it's a very different paradigm. Otherwise, at what point do people start going into the U.S. to sort of bring the U.S. yields down and act as a ballast? And that's, I guess, one of the key questions about how decoupled can these two economies actually get?
The best distinction that I've heard explained in the last few days on this, if you are exporting to America, you might have problems. If you're investing in America, you're probably going to benefit. if you get that red sweep. Because what's going to happen ultimately, what the Republicans and this former president is trying to achieve, Donald Trump, is to put the walls up, but then turn the heat up internally. So you're going to get a better growth profile, potentially another wave of inflation, and all that growth is going to get locked into the United States of America. And if you're outside of the wall, how much of a benefit are you going to get? And ultimately, not much. So when you see that euro-dollar move with everything we've just talked about, this is why the likes of Geoffrey Yu of BNY are all of a sudden talking about parity again, when only a few months ago we were talking about the opposite of everything.
Yeah, and he's not alone. There are other people also talking about this. The bottom line is, at what point does this not become a rate-cutting story and a differential in terms of the path of the ECB and the Fed? How much does it come down to growth differential? And regardless of what's going to happen, the U.S. is already on a trajectory of growth and could potentially only become more so.
Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Gold is on a record-breaking run. The precious metal topped $2,700 an ounce for the first time. Concerns over wider war in the Middle East and U.S. election uncertainty has sent investors flocking to haven trades. Gold is about 2% higher for the week. Bank of America noting this morning that gold posted their biggest inflows in 12 weeks. Harvard is struggling to bring in the type of cash that it used to. The university reported that cash gifts fell 15%, totaling less than $1.2 billion during the last fiscal year. That's the biggest decline in the last 9 years. There had been warnings around rising costs and alumni anger over the school's handling of anti-Semitism. Some of the university's largest donors, like billionaire Ken Griffin, have paused donations over the past year. Elon Musk is going solo on the campaign trail in support of Donald Trump. Musk held a town hall at a high school in the suburbs of Philadelphia Thursday night, where he discussed government regulation, inner-city crime, and freedom of speech. Musk is planning similar events in the area and across the state, with town halls scheduled in Pittsburgh and Harrisburg. The events are sponsored by the America PAC, which Musk founded earlier this year. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Thanks for this morning. Have a great weekend. Up next on the program, setting you up for the week ahead. We'll get you an update on the political campaigns going into the weekend with Joe Matthew down in Washington, D.C. From New York, this is Bloomberg. Housing starts and building permits coming in just a little bit softer. Yields turned, they were higher, they're now lower, down a basis point on a 10-year, 4.07%. We were at 4.1 a little bit earlier in the session. As for the FX market, the euro was weaker on the week for a third week, just getting a bit of a tailwind off that economic data in America. 108.57, up by 0.2%. That data, Lisa, going against the grain of what we've seen in the last 24 hours.
Yeah, otherwise it's been pretty impressive in terms of the U.S. economy, whether it's retail sales, whether it's jobless claims that came in below expectations, whether it's the economic data of earnings. And we have to keep going back to that, which just shows strength after strength. Consumer not landing, spending, luxury. It's wonderful, emotional, everything.
Apart from China, at the moment at least,
exactly.
If you're listening to LVMH. The bar for this stuff pretty low at the moment, apparently. We talked about this a few times on the program this morning. The Citi Surprise Index for the United States. Where's the data coming in relative to expectations? That's the highest since April. Coming into today, following better claims yesterday and higher retail sales. Equities at the moment up by 0.2% on the S&P 500. A grind higher into the weekend. We're looking at 6 weeks of gains on the S&P 500. That would make it the longest weekly winning streak of the year so far. We'll see if that can stick. We'll see what's in store later on in the session. We're up by 0.2% on the S&P 500. As for the week ahead, it looks like this. The trading diary for the rest of today and through next week. Today, Fed speak from Kashkari, Waller, Bostic. Monday, more remarks from Logan and Smith. Next Tuesday, results from GM. After all the car makers in Europe, we've had the cuts to the outlook from Stellantis, from VW, from some of the major German players. Will the US players follow?
Or will GM, like it has in the past, show strength from not the EVs, but from the combustible engine cars and trucks in the United States that still are selling? Will be interesting to increase that divergence.
On Wednesday, we'll get earnings from Tesla. On Thursday, another round of jobless claims. They pulled back just a little bit. We'll see if there's more of a hurricane effect in them in the coming weeks. And look out for the PMIs as well. Plus more earnings from UPS and American Airlines. Then on Friday, durable goods and my favorite, Mitch, consumer sentiment. Did you get the phone call?
Yeah, I did.
What did you tell him?
I told them that I think that it's on a glide path down to 2%, that inflation was mildly transitory if life is transitory.
Did Chairman Powell slip you some money to to make that kind of call.
Okay, what would you say? I know what you're going to say. So, of course, they're not going to call you.
5-year inflation expectations,
10%.
double digits. It's a problem.
I know, exactly.
It's a problem.
This is the reason why you are on the no-call list.
They're not calling me at the University of Michigan. Meanwhile, more campaign trail events coming this weekend as we enter the final 2 weeks of the race. We're almost there, but according to Libby, Cantrill at Pimco, we're not almost there because it might take a week to find out the actual results. Joe Matthew of Bloomberg joins us now from the nation's capital for more. Joe, welcome back. Walk us through the main events, the campaign interviews you're looking for into the weekend.
Well, you're highlighting the right state, and you mentioned the right company here, John. It's on to Michigan, and you said GM. That's actually where Kamala Harris is going to be today, Lansing, the GM plant that is set to get a $500 million grant from the IRA, converting it from an ICE plant to an EV plant. She's going to go there to call out Donald Trump for wanting to rescind portions of the IRA. Donald Trump's in Detroit. This is important. Early voting starts in Detroit tomorrow in what we could call the most critical swing state in the country. They will both be there tomorrow. And then they start to fan out to some of the other states that we're watching here. Donald Trump's going to be in Pennsylvania working at a McDonald's in Bucks County on Sunday. I'm deeply curious to see the optics as he, quote, works the fryers, unquote, having called out Kamala Harris, not believing, I guess, that she used to work at McDonald's. But look for the Obamas next week, not just the former president, but for the first time on the campaign trail, Michelle Obama, helping to promote, again, early voting. There are questions about whether Donald Trump will share a stage in the next 2 weeks with Nikki Haley, something else worth watching.
Interesting. Joe, thank you. Looking out for that going into the weekend there. Joe Matthew of Bloomberg. Down to the wire, Bramo. Very finely balanced. This is the final push. Don't you get the feeling this is the big final push? The likes of Michelle Obama on the campaign trail.
Absolutely. And we do know Michelle Obama is loved within the Democratic Party, so that is a good sign for Kamala Harris. She's also going to be on MSNBC on Sunday speaking to Rev Al Sharpton. This morning, the former president's on Fox News. Seems like right now they're going to their bases as well to make sure those individuals come out and vote.
These campaigns must be exhausted. They must be.
They are exhausted. I mean, we're exhausted. They must be exhausted.
Exhausted covering.
I know, exactly. So I can just imagine.
One city to the next. 1 minute they're in Chicago, and then like an hour later they're down in Georgia again.
Yeah, that's the reason why Kamala Harris videoed in last night.
Is that the reason why?
Oh, yeah, really?
Oh, controversial, Bramo.
I have no
quite
idea.
sure about that one.
I have no idea. I'm just making
Coming
stuff
up on Monday, Dan Morris of BNP. He won't make stuff up. He'll be alongside Stuart Kaiser of Citi, Adam Posen of the Peterson Institute, Jim Karen of Morgan Stanley. This was Bloomberg Surveillance.